This is a year where the narrative changes every single week.
We need to be aware that every data release you get could be leading us astray.
I think you'd want to see lower inflation data, and I think there's a good chance you're going to get it.
Fundamentally, you've got a labour market that still looks too tight.
The market's starting to believe the Fed about a second hike.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is CPI Wednesday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market slightly positive, 0.2%, 2 weeks away from a Federal Reserve decision. Listen to this. BMO, rate hike, foregone conclusion. Deutsche Bank, Jim Reed this morning, hike in July, pretty much nailed on. TK, July for a lot of people, even before this CPI print in a couple of hours' time. Done deal.
Done deal. I don't buy it for a minute. I think this is absolutely fascinating. The key thing right now, John, is we had 2 boring days. Yesterday was one of the most boring days in 10 years. I mean, it was a struggle here. I saw Lisa nod off at one point. Bramocam caught it. But it was slow. Today's not slow. You got yen through 140 to a stronger yen. There's a lot going on the data front. And, John, it's one big bet on a new disinflation.
Does that data in 2 hours, 30 minutes, Lisa, change the conversation?
That's the key issue, and core will be the key to watch here. I just want to say, before Tom throws me under the bus, I actually was interested in what we were learning yesterday, and I thought it was quite interesting. Today will be even more so because it's not the headline figure that I'm looking at. It is the underlying measures of inflation when you strip out some of the more variable costs that still are going to be quite high. Services versus goods? Yeah. Again? Yeah, and how much does services start to roll over? Because people are saying that you're starting to see that. To me, the debate isn't July, isn't September. To me, the debate is longer term, are we heading toward an inflationary regime that is higher for longer, not with respect to the Fed, but with respect to the economy? Or are we going back to that 2% or sub 2% inflation? That, to me, continues to be the debate, and any information that we get on that will be really important. The strength of the US consumer has been the story over the last couple of years, coming out of the pandemic with a bunch of savings. Year to date, the performance of tech gets all the headlines. Look at the airlines, 50% gains. There and thereabouts on Delta, American, United. Go through the top 10 performing stocks on the S&P 500 year to date. You'll find 3 cruise line operators in there, Tom. How much longer can that continue? Yeah, their Dow Jones Industrial Average candidate is what I would see here. Great article from Bloomberg today on the NASDAQ 100 rebalance. I learned a lot reading it. The basic idea that things are so out of whack with those 7 stocks, they've got to make an adjustment just, within pension and diversification. NASDAQ slightly positive this morning. Good morning to you all. If you are just tuning in, the data 8:30 Eastern time. Before we get to all of that, Bramo's going to go through the diary in just a moment. Here's the price action for you. It's British, folks. It's a brief. Equities slightly positive on the S&P 500. Do you not have diaries in the United States? You don't have diaries? We do. We write in them at night.
Right? And then you... Oh, right. They're journals.
Yeah, that's diaries.
But do you not have diaries about looking forward? You don't put it in a diary?
No, we only look back in our diaries.
You only look back?
Introspective.
Americans only look back and
at themselves. Yeah, exactly.
It's a brief.
Okay. This feels like a therapy session already. In the bond market, yields lower by a couple of basis points on a 10-year. We're down 3. Lisa, your 10-year, 394.
That key CPI read is going to come out at 8:30 a.m. Interesting to note that it comes 1 year after the highest inflation read in the U.S. going back to 1981. How much things have changed. We have come in on the headline number. Core really is going to be the sticking point, both literally and figuratively. 10 a.m., I'm watching the Bank of Canada because they continue to be the front runner. They had had a hawkish pause earlier in the year. Then last meeting, they were forced to raise rates. This meeting, they're expected to raise rates yet again to 5%. It's expected to be the last rate hike in the cycle. But to me, this is the key conundrum. Are they going to have to do an about-face once again and revert back to rate hikes? We have an 11 a.m. news conference with the Bank of Canada Governor Tiff Macklem. And if you wanted Fed speak, we didn't get it yesterday. Boy, do we get it today. Not only do we get the Beige Book at 2 p.m., which Tom is going to be reading every word of, but we also get Richmond Fed President Tom Barkin at 8:30 a.m., competing with CPI, interestingly. Minneapolis Fed President Neil Kashkari and ECB Chief Economist Philip Lane at 9:45 a.m. I'm throwing this in as Fed Speak because she used to be Fed Speak. NEC Director Lael Brainard, she's speaking at the ECNY event in New York. Atlanta Fed President Raphael Bostic, who has been the resident dove, he speaks at 1 p.m. And Cleveland Fed President Loretta Mester speaking at an NBR event at around 4 p.m. today. So that's just a little bit of taste.
I'm pleased you put Brainard on there. Very disappointed at the moment with the lack of public engagement from the NEC director.
I agree.
You're not the vice chair of the Fed anymore.
100% correct.
I said the same thing about Brian Deese at one point when he had the same role in the same seat.
He improved.
He improved.
Yeah.
I want to see more engagement.
Our visit with Brian was great.
Got to see more engagement.
I almost threw him off the roof of the Hay Adams Hotel.
I remember that conversation.
Brian, your answers have got to be longer.
He got better. He engaged more. We haven't seen enough.
Well, Brainerd's, this is a really interesting thing because as people become Fed visibility, think Bernanke or others, Mankiw, I remember at the White House, they change, they learn, they adapt. And it's even harder for her because she's adapting from Fed speak over to White House speak.
Do you think that her lack of engagement is her choice or Biden's choice?
Don't know.
It seems like Biden takes a pretty hard line with not allowing certain people to have too public of a voice, and we've seen that pretty consistently.
You think that's the case with Brainerd?
No idea, but I know that that's been a consistent theme through certain offices.
Well, disappointed nevertheless, and let's hope we see more public engagement from the NEC director in months to come. Joining us now is Russ Kostrick, Portfolio Manager for the BlackRock Global Allocation Fund. Russ, wonderful to catch up with you, sir. The data drops in about 2 hours and 24 minutes' time. What are you and the team looking for, Russ?
Well, good morning, Jonathan. I think we're looking for probably what everyone else is looking for. What's happening with core? What's happening with services? This is a little bit of an interesting print because unlike most of the last year where you consistently surprised to the upside and markets became accustomed to that, I think most investors are going to this number expecting a softer print. So it will be interesting not only see what the number comes out at, but what is the market's reaction to it?
Russ, what does big tech do if we get a legit disinflation? I'm not talking down to 2%, but if we, migrate 3-ish or 4.1-ish or that, on the duration analog of big tech, does that give them a second wind?
Tom, it's a great question. I think on paper, theoretically, it does. But here's the interesting thing. Big tech is, on a relative basis, it has been a little bit of a market performer the last month, but obviously year to date, you've got the NASDAQ up, 39%. Rates bottomed months ago, and we've seen 2-year nominal, 10-year nominal reals grinding higher for a couple months now, and tech has mostly ignored that. And unlike in 22, when tech really took its cue from the rate market, what's happened this year, as you all know, is you've had the secular theme about AI, and that has driven tech higher, even in the face of higher interest rates. So I think we've seen a little bit of a decoupling between what the bond market is doing and what tech is doing, given these secular themes.
I mean, the secular themes are all fine, but your job now in every shop is absolutely brutal on allocation. I really don't care what your allocation is for July and August. I want to know the method you're using to make that allocation.
So I think there are a couple of things you're thinking about right now. The first and most important of which, what is the state of the economy? What are we expecting? And it's been tough. It's been tough because that narrative, that regime has shifted about every 6 weeks this year. But I think the key thing for our thinking right now, we still have a little bit of a positive tilt to equities. We're still a little bit underweight duration, is that nominal GDP, real growth plus inflation, is going to continue to surprise to the upside. And that means you're still a bit cautious on bonds. You still question whether or not bonds are going to provide that long-term hedge, at least over the next 6 months. But the positive side of that is in an environment in which nominal GDP is going to be, let's call it 5% in 23, that's an environment where earnings are probably better than expected and equities can still grind higher throughout the year.
Russ, can we still see disinflation in that kind of environment with robust economic growth?
I think you do, and I think we are going to see lower inflation, both at the headline and the core number. But, the big question, which I think y'all were talking about, before we a few moments ago, was, how low are you going to go? It's not obvious at this point that you're going to go back to, let's call it the post-GFC environment, where not only was inflation at 2% or below, but it was remarkably stable. And then we are in an environment where inflation's heading lower, but maybe not to that same equilibrium and probably not to that same level of macro stability.
Where is that not being priced into the market right now, where a lot of people increasingly are reverting back to the old paradigm of lower for longer over the long term?
I think there are a couple places. You still have to kind of question, are you being adequately compensated with the term premium? In other words, that premium you get for going further around the yield curve in an environment where inflation is probably going to be a bit more sticky and a bit more volatile. So what we've been doing, we've been hiding at the front end of the curve. And I think, as everyone knows, you can get tremendous carry right now in cash and cash-like instruments, commercial paper, for example, and there's no need to go out long on the curve and take a lot of rate risk when you still have that uncertainty about what is being priced in.
Russ, just talk to me about your cash allocation. How consistent has your cash allocation been through this year?
It's been moving around quite a bit, and there are a couple of reasons for that. The first of which is we've moved our equity allocation pretty significantly higher over the course of the year, from being underweight in 22 to more of a market weight or slightly overweight in 23. But the other goes back to this question of what is your hedge? Last year, the answer was easy. There was no hedge. Maybe the dollar is the best you could do. I think the question about what is your hedge in 23 is going to depend on your view on inflation, your view on the stability of inflation, and what yields you're getting on the 10-year. So part of that movement in cash comes down to, can we rely on bonds as a hedge? Probably not yet. Or are we still using a little excess cash to dampen that portfolio level risk?
Hey, Russ, wonderful to get your insight, your input on CPI Day. Russ Kostrick there of BlackRock, the Global Allocation Fund, just on his cash allocation and the amount of times the narrative has changed over the last year or so. I was just going through the US 2-year, the journey of 2023. Remember when the start of the year was about soft landing, then it was no landing, then it was about hard landing. March was hard landing. 2-year dropped to about 350. On a 2-year, Tom, we went back through 5.1% in Thursday's session. We're back down to 486 this morning.
You see it everywhere, but I do agree that 2 years is a nice thing to study here, folks, if you'd like to look at that. I looked at the 5-year real yield yesterday, and we're well out to historic 3 standard deviation moves to a higher real yield. And I do take Russ's point that this is about nominal GDP and the miscalculation of those two moving parts, the real economy and inflation, and what it means for earnings season. And I mean, I know we're supposed to say, OMG, earnings season's going to be terrible, we're all going to die, except I've said that and been wrong for the last 6 quarters.
JP Morgan Friday, kicking things off. Bramo, we did go from soft landing, no landing, hard landing. It feels like we've swung back to soft landing again and forgotten about the banking failures of March going into April.
Except this soft landing has a slightly different tenor. The idea that you could have higher yields and stocks still performing well, and credit still performing well. And this is the conundrum. Can you get ongoing disinflation with growth that surprises to the upside? That, to me, is a tension that is unresolved.
The first read of the day, Matt Bessler at Bloomberg News reporting on inflation and his study of it. Matt is first rate out of Michigan, and also James McIntosh at the Wall Street Journal. And McIntosh tears to shreds the certitude of our belief in inflation because we have this fictitious plug-in of our guesstimate of what Jonathan Miller's rent looks like in New York City. This is, I'm going to say, after McIntosh's article, which I thought was great, it's OER Wednesday here. The key thing today in the inflation surveys, John, is what McKee says about owner's equivalent rent, which to me, it's a double fiction. It's a plug-in.
Surely the Fed knows this, Tom.
They know it, and they keep it separate, but everybody's still addicted to this guesstimate of what real estate's doing.
There is a measure of uncertainty, and the James McIntosh story was really interesting. The column talking about how if you measured it the way that Europe did, inflation would be substantially lower in the U.S. That said, is that temporary? You have the likes of Mohamed El-Arian out talking about the likelihood of a stickiness underpinning some of these other measures, whether it's cars that could potentially revert back, whether it's airline prices.
Dan Skelly coming up to talk about this in the next hour at about 7 a.m. Eastern Time. Looking forward to that conversation. Equities right now on the S&P 500, positive by about 0.1%. Coming up very shortly, we'll catch up with AMH down in Lithuania as Zelensky speaks right now, saying Ukraine can be a NATO member when we're safe on our land. Ukraine knows it can't be a NATO member during the war. That conversation coming up next.
We want to be on the same page with everybody, with all the understanding. And for today, what we hear and understand that we'll have this invitation when security measures will allow.
Ukrainian President Zelensky speaking on NATO membership just yesterday, speaking this morning as well, alongside the NATO Secretary General Jens Stoltenberg. Here's some of the headlines from that. Zelensky saying Ukraine knows it can't be a NATO member whilst the war is ongoing. Says that Ukraine can be a NATO member when they're, quote, safe on their land, and that Ukraine needs clarity, Tom, on security guarantees. The Ukrainian president speaking just moments ago.
It is the summer of 2023, Johnny. You know, Lisa mentioned this yesterday. We're in year 2 of this war. I would say America, John, I don't know if this is true in England or in Europe, but America sort of has a 4-year war time frame, going back to the War of the Colonies, where the colonies won, but also other wars forward. We have like a 4-year...
I think that shade's a week old, isn't it?
We have a 4-year gap on a war. And if it's longer than 4 years, Americans get upset. And we're only like year 1.5.
Pew Research, do you want the numbers?
Yeah, please.
44% of Republicans and Republican-leaning independents say the US is giving too much aid to Ukraine. 44%. That number for Democrats, 14%. Look at where we were in March of last year. Republicans were only 4 percentage points more likely than Democrats to say the US is providing too much aid. Today, Republicans are 30 points more likely to say so.
Yeah.
That's the election campaign right there in a poll going into next year on this one issue.
It goes back to the isolationist tones of the middle 20th century, to say at the least. We need a briefing from Lithuania. Maria Tadeo giving us great work there. And also Anne-Marie Horton, our chief Lithuania correspondent from Vilnius this morning. Anne-Marie, I want to go back to 2008, pre-Bucharest. This is Condoleezza Rice, quote, "We, of course, are and have been and will continue to be supportive of Ukraine's transatlantic ambitions." How has it changed from 2008? We have a war. You have Zelensky there meeting with the president in the New York 8 o'clock hour. Translate for us the Vilnius transatlantic ambitions of Ukraine.
Well, a lot of people here would say that 2008, they're feeling a deja vu in terms of the Vilnius summit and the Bucharest summit, because it was at that Bucharest summit that you really had Germany, led by Chancellor Merkel, the U.S., led by President Bush, at odds about what is going to be the path forward for not just Ukraine, but Georgia as well. And the U.S. at that time really wanted a more direct, concrete plan. The Germans were a little bit nervous, backed by the French as well. And what you got was ambiguous wording about where Ukraine could potentially fit in the future of this alliance. And what many analysts would say is that you can almost see a line to the crisis we have today. Some would say that because of that summit, it was too ambiguous. It basically put a target on Kyiv's back. Putin knew that they wanted to move west, they wanted to move into this alliance, but they were still not protected by the Article 5. They were not protected by that alliance. And what you saw from the communique yesterday in the wording and the language, which you heard from Kuleba when I spoke to him yesterday, what you're hearing from Zelensky now, which seems to be a little bit of softening of a tone and reconciliation of the language, but they wanted a more direct invitation and a more concrete timeline. And that is something that this group was unable to do.
Emery, in the last 24 hours, and this is all speculation, and I'm summing in various news sources, don't quote me on this, but we've had an assassinated Russian general. We've had another major Russian general killed in some form of missile attack involving British missiles, whatever. What is going to be Mr. Putin's response to what you're witnessing in Lithuania, given these two isolated deaths of generals and the general state of the Russian front east of Kyiv?
Well, I think what you see from Putin is that he is going to try to continue this offensive, as you see the military aid that is being discussed here, the cluster munitions that Ukrainians are going to get from the United States, the next missile tranche they're going to get from France, the 700 million euros they're going to be getting from Germany in a new aid package. This is going to obviously concern Putin, but he's going to continue in this fight, especially in eastern Ukraine. I would say, though, that what Putin has said in the past regarding what's happening at NATO with the ascension of Sweden at this summit, Finland, which is already joined. He said that he had no problem with Finland and Sweden joining the way he has with Ukraine, because he calls Ukraine that there is still territorial disputes. But his issue with Finland and Sweden is if there was going to be any infrastructure changes on those countries, then Russia would have to act in kind. But you have to think how difficult this is at the moment for the Russian military to act in kind on the Baltic Sea when they have an all-out war that they're still trying to win and losing at the moment in eastern Ukraine.
Meanwhile, never one to let an opportunity pass to do political grandstanding. We're seeing members of Congress come out and push for a larger defense budget in response to some of the discussion around NATO. A lot of disagreement about how much aid and what parameters go around any kind of money to Ukraine, as well as certain social issues. But this, to me, stood out. Senator Dan Sullivan, Republican from Alaska, saying that the most immediate priority is maintaining U.S. aid for Ukraine, but that effort could be undermined if the majority of NATO members continue to fall below the 2% threshold of spending on defense. How much is that really one of the main thrusts right now, getting guarantees from those that perhaps are under contributors?
Well, I also think John's Pew Research was also prevalent into going into the 2024 election and the problem facing Republicans. You have many of these defense hawks. They want a bigger defense budget. They don't want an extra supplemental when it comes to Ukraine aid package, although obviously they would sign up for that. They just want a bigger defense budget. And what Republicans here on the ground in Lithuania are saying is that to make our job easier back home, because there are some fractures within the Republican Party for our constituents about how much money and aid is being sent to Ukraine, you all need to hit your 2% target. And the language has changed at this summit. It is no longer a ceiling or a goal to hit 2%. It is the floor. They want all of these numbers to hit 2%. And at the moment, it's about 11 countries that are actually hitting that. You have the likes of Luxembourg, Canada, Italy that need to start catching up. And that is their message here on the ground.
MH, can we just lean into the presidential campaign a little bit more? For the Republican Party, how are respective candidates, thinking Nikki Haley, traditional Republicans, actually capturing this story compared to, say, the former president, Donald Trump?
Well, you're seeing a lot of different views within these candidates who want to be the nominee. The former president says that he, within 5 minutes of office, could end this conflict and get on the phone with Putin. I think you're going to see this administration want to have a really big contrast with the former president when President Biden heads over to Finland next. Since we have not seen a U.S. president in Helsinki since Trump was there, and then sided with Putin instead of his own intelligence services regarding Russia meddling in the 2016 election. You have Ron DeSantis, the governor of Florida, have to backtrack. Clearly, he upset a lot of hawks or potential donors that were supporting him when he called it a territorial dispute. And then he came out a lot more forceful in his backing of Ukraine. And then I would say, really, the most hawkish you have, even above Nikki Haley, who obviously has foreign policy chops given her work at the United Nations during the Trump administration, Mike Pence, really setting himself out to be the individual to watch when it comes to Russia's invasion of Ukraine, because he was the first of these candidates to actually go to Kyiv and stand next to Zelensky and talk about America's support for the country.
Interesting. AMH, great coverage. Looking forward to catching up some more through this morning. Anne-Marie Hordern there over in Lithuania. Tommy went through those numbers, the fading support in the Republican Party for potential voters. You just wonder how this is going to be handled going into next year.
That's always been there, and I don't mean this with any disparagement, folks, but the fact is there has been an isolationist tendency, particularly from the Midwest. My grandfather was what was called a Chicago Tribune Republican, which just means stay out of England, stay out of the continent of Europe. That is embedded in American politics. And it's not a surprise that there's a part of America that feels that way.
When were we invading England?
I think it was just another jab at the mother country.
The mother country.
Just why not?
This is after the war.
There's an opportunity, so why not?
This is after 1812. They burnt the White House.
Back-to-back gains on the S&P 500. Let's see if it becomes day three. Equity futures right now on the S&P positive 0.2%. Waiting for inflation data in America about 2 hours away. Going into that, equities on a NASDAQ up by 0.2%. In the bond market, what a trip on a 2-year yield. Through 5% in early March. Then We collide with SVB and a handful of other banks as well. The 2-year drops to about 3.55 in late March. Then last week, back through 5%, 5.11%, a new cycle high. Then backing away to 3.86, looking for a softer print on inflation this morning. What's been interesting, as yields back up just a little bit, back down, the dollar weaker. Take a look at this coming into today. 4 days of weakness on DXY, longest streak since March. The euro firmer again, back through 110, Tom. 110.25 on that currency pair.
The correlation here, what we see on the Bloomberg Launchpad, John, is tangible this morning after 2 really boring days, Monday, Tuesday. And the answer is things are really moving. I've got yen through 140. In the yield space, you mentioned the 2-year. I've got a combined 2-10 spread from 111 beeps out to 91, less curve inversion, and the real yield pulling back. There's a whole disinflation tendency to what you see in the combined data.
I keep going to the UK, Tom. You've gone to Japan. Let me go back to the motherland as you take jabs at it.
Yes.
We had a financial stability report from the Bank of England. We could talk about that in just a moment. I wonder what his mortgage is doing, Tom. The typical household rolling off a fixed rate deal in the second half of 23 could face a £220 per month increase in their mortgage costs based on current rates. They pushed this out. They went out to 2026. By the end of 26, about 1 million households would have seen their payment go up by more than £500 a month, assuming, of course, various things stay consistent, Tom. But ultimately, there's going to be a lot of people in a lot of pain as these mortgages start to roll off and they have to go and make a new agreement with their banks.
It shows that each country's different here, but the end result is out of the pandemic as we're making it up as we go. And I certainly got that feeling from Sintra. We'll have the inflation data for you here in 2 hours, just 1 minute less than 2 hours. That's going to be, it's going to be important here. John, on the American economy.
Yeah, Rabita Faruqi and the team at High Frequency Economics expecting a 3.1% year-over-year increase in headline CPI. That would make it the lowest since March of 2021. They go on to write this. We predict a further deceleration by year-end to around 2.5%, and the annual change could hit the 2% target, Tom, by early next year.
A stunning statement for the inflationistas, the people worried about a sustained statistic at 4%, or dare I say, even higher. We'll talk about Bank of America's important chart in the last 24 hours that shows those different options, those different choice sets. We get a brief now on low inflation in America with Rabita Faruqi, Chief U.S. Economist with Carl Weinberg at High Frequency Economics. Rabita, that is a stunning statement. I want to go to the core principle right now of your low inflation call, which is the mathematics of real GDP plus inflation equals the animal spirit of the nation, nominal GDP. Are you and Carl modeling that we will see a sub 4.5%, dare I say, sub 4% nominal GDP soon?
Good morning. Great to be with you on the show today. Certainly within the range of possibilities, we are looking for a very sharp deceleration in inflation, not only today, but going forward. Economic activity is set to slow. If we look at our numbers, if we look at what's happening with household spending, and we do think that that is going to have an impact on company bottom lines, which in turn will have an impact on what happens with hiring, the labor market, and what happens in terms of nominal growth. What we really need to understand is, where the direction from here. We've constantly, underestimated the resilience of this economy, but we are seeing some, moderation. If you look at consumer spending, it's been pretty much flat since February. So I do think that the lagged effects of policy are finally catching up, and that we are going to go to a sub 1% growth rate in the second half of the year, and that has implications for demand for what companies are going to face and what is going to happen in the labor market.
Rabita, in the soup that you describe, one idea here is that we had a medical event, a pandemic, and that gave us a sequence of stimuluses. As Olivier Blanchard mentions, we ended with the third, I believe it was, Biden stimulus. Okay, fine. We're not going to have the excuse of a pandemic with a Rabita Faruqi sub 4% nominal GDP. Are we out of optionality if we get down to that slow economy?
It really depends, right? I mean, we're looking at a slower economy. We're not looking at a contracting economy. So, a recession is still not part of our base case. So I do think that there is still, positive momentum. It's just that managing that positive momentum in terms of monetary policy, I think that's where the challenge lies. And, we think that, the Fed is definitely determined to go a little bit further. We think that they really should sit it out from this point forward. But July is pretty much a done deal. It's what they do afterwards. And I think the data on inflation, especially headline inflation, we have to remember that is their mandate. We can talk about core all we want, but once they, start moving convincingly towards that target, I think that that message has to be managed a bit more carefully. But I do think that, this economy has positive momentum. We do think that we're going to avoid a recession. It's just that we're watching the Fed very carefully in terms of how far they push this.
So what are you looking for in terms of what's a policy error and what's the correct course of action? You talked about inflation getting down to 2%, which is the goal from the Fed. Wouldn't that be a green light for them to move away from a restrictive policy?
No, because, what we're seeing, we need to sort of keep rates at this level for inflation to continue to move down. We can't sort of move to a less restrictive stance. That is, something that the Fed is struggling with. What is a sufficiently restrictive stance? We do think that they're there already. They don't think they're there. They're going to go a little bit further. But to consistently bring inflation down to affect the labor market, and to affect that demand side of the economy, they do need to keep rates restrictive for a little while. Next year, the picture changes because as they hit that 2% target, then policy doesn't need to be as restrictive. And we do have 100 basis points of easing, built into our forecast, a quarter point in each quarter. And I think that's probably what the Fed has. And that's probably, this is what we expect to see over the course the rest of the year, where rates stay higher. And then starting next year, they start adjusting their policy rate lower.
We've been talking throughout the morning, John was bringing up the narrative whiplash that we've been getting. Every week seems to be a new narrative, whether it's soft landing, hard landing, no landing. Here we are in soft landing. And what a lot of people are saying and what, frankly, equity markets are signaling is that we could get our growth and have it too, right? We can eat our cake and have it too, in the sense that you do have inflation coming in. You do have robust growth that continues. Can we normalize without the pain that Jay Powell talked extensively about last year at Jackson Hole?
That's the real challenge. And if you look at what the Fed has done and managed to accomplish, and with 500 basis points of tightening, minimal damage to the labor market, no damage to the labor market, and really growth that is continuing to outperform, but inflation is coming down, wage pressures are not accelerating. So that, in terms of policymakers' view, that is ideal. That is something they should, take comfort in. But the issue is the economy has continued to outperform. Core inflation has been sticky. We do think that component is also going to start easing as that housing, the lagged effects of lower rents, flow through. And we're also seeing, if you look at consumer spending, we are seeing a deceleration in services, right? We're seeing a deceleration in food services, accommodations, recreation services, roughly flat. So we do think that effect, that pent-up demand, that we do think that that's going to also start easing in those components of core, the super core, the core services ex-housing component. And I think that's going to be an important development in the second half of the year. And, that's something that we're tracking.
I look, Rabila, at sort of the moment we're at. We're going to get an inflation report. We really don't know what it's going to be. The zeitgeist this morning is disinflation. Then do we just wait for the next data point? How do you figure out a trend in inflation? Is it 3 months? Is it 6 months? How do you do that?
We are going data point to data point, but we do think that, like I said, if you look at inflation, if you look at where it is, it will be in June compared to 3 months ago, 6 months ago. That's an important improvement. If we go look ahead, our estimates suggest that this disinflation is going to continue. It's going to accelerate. The Fed is going to get
It's going to
target.
accelerate. Wow.
Yep. Yeah. And if we think inflation is going to get to 2% from 3.1, headline CPI, that's going to be, a pretty substantial move. But there are still a lot of uncertainties. We're not looking for, any geopolitical events, but those could be, a factor. We hope not, but obviously that is something that we're watching very carefully. But really for the Fed, this is the ideal situation where they have raised so much. They have not caused damage to the labor market. We don't think they need to do that. We think they need to be very patient from this point on and, after they move in July.
Let's see how the data changes that conversation. Rabila Faruqi of High Frequency Economics, that data 1 hour and 50 minutes away. Thank you. This from Citi this morning, an upgrade yesterday for JP Morgan over at Jefferies, a downgrade this morning to neutral. This is what the likes of Citi have to say going into earnings season on Friday. JP Morgan is viewed as a high-quality franchise with a strong management team and a balance sheet, and in turn is rewarded with a premium valuation. On that last point, that premium valuation, this is why they've downgraded the stock. We believe the premium valuation has returned and we move to the sidelines. At least the latest on JP Morgan, this from Citi this morning.
Especially notable considering that JP Morgan shares are up 12.4% so far this year, which sounds not bad, but pretty shabby when you take a look at some of the big tech names, right? I mean, it's not as if these have been flying. That said, it highlights the pressure you're going to feel on some of the banking sector starting on Friday, even if the rest of earnings are much more positive.
But wasn't this gloom the same 90 days ago? I mean, where were we 90 days ago?
Big gloom for the regionals 90 days ago. Big gloom.
Okay. Away from that, though, but it's just in general earnings. I just think we're just reduxing where we were 90 days ago. OMG, the world's going to end. I mean, there's John Williams' favorite market economist. Rabila Faruqi there is with John Williams of the New York Fed, right back to, low R start.
I'm not sure Bramo said the world's going to end. Not today, anyway. Not this morning. Not yet.
I will just say this. Hold on. I've actually been reading a lot of notes about the earnings season, and they've been upgrading their expectations, one after the other, saying that we might have seen the trough last quarter, which is interesting. It's not the world is going to end kind of discussion.
Citi's take on things right now, point by point. So 3 issues going into bank earnings. They say bank stocks have underperformed the broader market due to key issues. There's 3 of them. Funding pressures impacting net interest income. Number 2, regulatory reform pressuring longer-term return profiles. And 3, credit quality concerns ahead of an economic downturn. And on credit quality, this is what they say. Credit quality will be a wild card, as we are likely to see some one-off hits. Their view is we continue to believe this cycle will be muted. But I think already going into Friday, Tom, that's going to be the focus for most people.
Yeah, I the granularity of this Friday, I think, is tangible. I don't disagree with that at all. Can I switch gears here?
Without a doubt. Do you need my permission?
I'm looking at the phone.
He's not looking for it.
Drive it in. The driver says, look at your phone, and the Bentley. And
what have you got?
And I've never seen this, John. It was 98 degrees at 2 a.m. in Phoenix. John, let me translate this.
That's like high 30s.
Global. No. Let me translate this to our global audience. Phoenix, Arizona on a Saturday will be 48 degrees centigrade, John. I mean,
that's nuts.
That's nuts. I mean, I don't know what else to say, but folks, when you take Fahrenheit over to centigrade, you get a response because it's just highly unusual. I mean, there's no other way to put it.
There was an article actually in Business Week about when things get too hot for humans. And part of the issue is also humidity. And some of these places don't have the humidity. When there is, you can't sweat and cool down. I find this all really interesting.
93 in New York today.
Yeah.
Low 90s.
It's just it's just like, where are we in this?
Summer. It's a beautiful thing.
Is it?
Being a Brit, we complained about the weather. Didn't matter what it was doing. Raining, bad. Sunny, bad. Oh, it's hot for like 2 weeks in the summer. I refuse to get involved in that. I refuse to get involved. Futures, positive on the S&P.
The economy is upside down and backwards, and we need to be aware that every data release you get could be leading us astray because it's not clear yet. Are we doing the rebalancing or are we going down?
That was Claudia Sahm there, the former Fed economist, weighing in on the US economy. We've been all over the place, in her words, upside down and backwards, and we need to be aware that every data release you could get could lead us astray. Well, we get another data release a little bit later on this morning, and we haven't been through the estimates just yet, so let's go through them right now. Headline, which of course gets a lot of headlines, year-over-year CPI, looking for that to move down from 4% in our survey down to 3.1%. On Wall Street, a very, very focused view on month-over-month course. So you strip out food, you strip out energy, and others of you will strip out some other stuff too, to tell whatever story you wanted to tell, of course. 0.4% was the previous read. Month-on-month, Tom, looking for that to come down to 0.3. That's the estimate in our survey.
We take it out to 1 decimal point. Maybe you'll see 2, but I'm starting to see houses, adult houses really trying to game this, go out to 3 and 4 decimal points, which I find absolutely ridiculous. It breaks every scientific thing I learned in microbiology years ago. You just don't do that because it's not that accurate. The sum of our study doesn't warrant going to 3 or 4 digits.
I take your point. Everyone who comes on says maybe the models are broken, and guess what? Our model said is going to be, 2.9673. So you should listen to that. So there is an element of truth there. I think the bottom line is right now there is a consensus hovering around this. What would it take, and where is the balance of risks for markets to really get disrupted in the response?
I like,
to
John,
some sort
what the
of shift?
United Kingdom does. I mean, they just declare victory.
Who's declaring victory? What are we doing now? Is this another dig at the UK?
100%. Is it before or after we invade?
Are we talking about the war, or are we talking about the inflation
the governor
data?
of the Bank of England was very responsible, and he said it's too early to declare victory.
Well,
That's more mathematics
well, the UK's,
than this idiocy we do.
The UK's in a delicate situation on the inflation
Huge,
front.
yeah.
And so's that Bank of England governor as well, Mr. Bailey.
I think they're doing better delicately than we are in explaining it to the audience. We're going to 4 decimal points, which is absurd. It's all there is to it. Have you noticed how Brent crude is crepeth towards $80 a barrel?
Yeah.
Quietly here? That means it's time to talk to Stephen Shork. He's principal of the Shork Group. He writes a newsletter, folks, on 8 pages, constantly using 3 and 4 decimal points as well. Steve, just go to the blunt instrument, which is oil finally gets a lift. Is there legs to it?
Yeah, absolutely. I think that what has really sidelined the bulls over the past 6 months was the waiting for Godot moment with China demand. And it never really quite showed up. But we're certainly seeing a response now in the market with production. We're now at the peak gasoline season, of course. July season has been very strong at this point. We've seen significant drawdowns. In fact, supply cover, the amount of days forward looking in every market except for propane, so distillate fuel, gasoline, and so forth, are all down lower on a year-over-year basis and on a 5-year basis. So, Tom, as I've been saying since the beginning of the year, coming in, the bottom part of our range for oil WTI was that $70 mark, 75 for Brent. Of course, we dipped below that, but I've been saying all along, I take a lot of confidence in our modeling that every time we dip below 70, we've popped right back above it.
I mean, for those of you on radio, to be honest, Mr. Shork is styling with the grizzled beard look. He's not shaving until the Phillies win 3 games in a row after the All-Star break. Steve Shork, what does the heat wave do to energy in America? What is actually, I mean, you are so into the micro data. What does a heat dome and 117 degrees in Phoenix do to our use of energy? I think I brought Steve Shork to silence there.
We didn't want to talk about baseball, so he left. Technical connection there. The problem with it, Stephen Shork at the Shork Group will try and re-establish that in just a moment.
That's the way Bramo is with us. I mean, you wouldn't just...
What's that old dial tone?
You don't complain about my beard, so that's probably a good thing, you know?
Shork was styling there. He had the Tupper Lake look, like Lisa.
Why are they taking a wide? Just get on 2 boxes. I don't want anything to do with
it.
Steve Shork there on the granularity of oil. And to me, it's a wild card. We got this gift of low oil prices, John, within our early disinflation. And do we get more disinflation here coming up? How do you do that pushing against $80 or $82 Brent crude?
Data, 1 hour and about 40 minutes away, 1 hour and about 39 minutes away. I don't watch much TV anymore, TK. Don't watch that much sport either at the moment. I've pulled back just a little bit. But I will watch your new edition of what is this?
This is really
sit
cool.
down with the Red Sox.
They came to me. It's John. It's like if they came to you and said, "Could you do the chief financial officer of AC Milan? Go to Milan. Go to all those memories you have." This was so cool. I can't say enough about it. The Red Sox behaved. And this is the team, the Fenway Sports Group, that owns the Red Sox, owns the Pittsburgh Penguins. And, John, they have a small interest in a soccer club in Liverpool. We talked a lot about Liverpool. It's not just about the Red Sox, but it was just absolutely great. I fell right there on radio. I'm walking up the stands.
You didn't
in the
fall
expensive
over.
seats. I almost fell right over.
Did you?
My chin.
Okay, I've got to ask the question on behalf of Liverpool fans, including Bob Michael over at JP Morgan.
Yeah.
Are they still selling the club?
No, it didn't come up. I was told that the meeting would be over if I brought that. They talked about they are adaptable and amendable at any point. Sam Kennedy joins, who runs a Red Sox operation, and both Sam Kennedy and Julie Swinehart made very, very clear they're hugely flexible. There's very little McKinsey going on here. There's very little strategic analysis.
Sports teams adapt and adjust to the conditions.
Do they adapt and adjust, Tom?
Adapt and adjust. This is really, really special. Julie's out of the Midwest. She's a Cubs fan, and they brought her in. She's like the chief adult for the Boston Red Sox. Everybody else is running around doing sports and, Mo Salah and Sidney Crosby and all the rest of it. And she's like, who's going to pay for this?
Right.
Hello, excuse me. How high can ticket prices go?
Tom, there's certain stadiums, particularly the old ones, and you mentioned AC Milan. When I walk into the San Siro, as a fan, a lifelong fan, there's just a feeling.
Yeah.
And people might laugh about this because they might not be connected to it, but I tell you what, you're overcome by emotion. You almost get quite teary when the crowd really starts to make a noise. Can you talk to me about Fenway? Just how magical Fenway is, because I've still never made it over to Fenway for a game.
Well, you got to go to Fenway. The only equivalent in America is Wrigley Field and the Cubs and Julie Swinehart, Chicago. But what I would say is these people are dealing, John Henry and those crew are dealing with the afterthought that they saved Fenway Park. Everything they do after their initial action when they took over from the Yawkey family is secondary to the fact they wanted to tear down Fenway Park. And they said, no, this was huge in Boston at the time. It transfixed the city.
Is that settled now? Or do you think there's pressure to renovate and rejuvenate the stadium once again?
I don't have a name in front of me, but I interviewed the architect that saved Fenway Park, built Camden Yards. It's very, very, very well regarded. But they basically, John, saved a 1912 stadium from the inside out in real time while they kept playing baseball. So, they did it. It was great. It was fun. And, the best part about it was you get the Lux box. I mean, Seth Magdalener's there, and you got, it's not like surveillance.
You get tickets now for the Red Sox.
I didn't get tickets, but I got the Lux box.
Is that what this was about?
You walk in, and it's KM hot dogs, and, it's all laid out. Hot dogs and lobster rolls and Narragansett lager beer. And it was just really tough lifting.
Very Boston.
It's very Boston.
Very cool.
Very
Looking
Boston.
forward to this. Fenway Sports Group Executive VP and CFO, Julie Swinehart, coming up at 9:30 Eastern Time
tonight. Is that
tonight.
when it is tonight?
9:30 p.m. tonight.
It's going to be on YouTube, too. We're really pushing this on YouTube.
We're all staying up for this. We're coming round to yours with some popcorn to watch this.
No, I'm going to be asleep. But
this is a great promo.
We're really just killing it.
We'll wake you up.
Is this why you killed the Stephen Schork line? Is this why you killed the line?
Yeah, I killed that. But seriously, folks, this is going to be out on YouTube. And Lisa, John, and I are making a huge effort on Bloomberg Surveillance on YouTube because you've asked for it. We're doing that with Seth Magdalener's Chief Future Officer.
Love a TK promo. Watch it. Stay up tonight, obviously. Great.
That worked out.
Dan Skelly, Morgan Stanley Wealth Management, coming up very shortly. Big morning ahead. CPI just around the corner, 8:30 Eastern Time, so 1 hour and 35 minutes away. Then it's on to PPI tomorrow morning, and from there, we move on to bank earnings. JP Morgan, Wells Fargo, Citi, and we ramp up through earnings season, going through July and into August. Right now, going into the market open several hours away, equity futures just about positive 0.16% on the S&P 500. In the bond market, 3.5%, back below 5%. Your 2-year right now, 4.86. Your 10-year in America, 3.95. Yields just a touch lower. The dollar just a touch weaker. This is Bloomberg.
This is a year where the narrative changes every single week.
We need to be aware that every data release you get could be leading us astray.
I think you'd want to see lower inflation data, and I think there's a good chance you're going to get it.
Fundamentally, you've got a labour market that still looks too tight.
The market's starting to believe the Fed about a second hike.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Inflation data in America just around the corner. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market showing some back-to-back gains on the S&P 500 with a lift, a little one this morning, up by 0.1% on the S&P 500. The data, Tom, just around the corner.
I agree. There's a little bit of a lift on equity, but I think the data and the anticipation of further, maybe greater disinflation has adjusted the linkage here between equities, bonds, currencies, commodities. You go over to a weaker dollar, DXY under a 102. You got surging Japanese yen, well under a 140, stronger Japanese yen, and coalesces around a bond market, which signals how important 830 is.
Fed officials say there's still more work to do. President Daly early this week saying a couple more rate hikes this year. Lisa, you just wonder if this data at 8:30 changes that conversation in any way, shape or form.
Or changes the messaging, where they want to have a hawkish message at a time where people are pricing out the potential for the Fed to stay at this type of level for a longer period of time. They are going to signal a hawkish rhetoric. Are they going to follow through if you do see a deceleration and disinflation at the same time that people see growth continuing?
You're going to see the deceleration, but what's interesting to me is I'm not going to get upset at Fed officers that miss the tipping point, because by definition they miss the tipping point. And to pick on Mary Daly, who's just the latest speaker, I mean, it's okay if she gets it wrong, because they're being cautious and conservative. And then at some point they'll go, oops, we got it wrong, and down they come.
Well, there have been some bank failures in her district which got tons of attention.
That's a separate story.
3.5 months ago.
Yeah, I'm not going to
Well, I would say those stories were conflated 3 months ago. We came out of March into April. There was a feeling that some people thought that was it. The Fed's done. Credit crunch is on its way. 3 months later, and Tom, we're talking about higher rates again.
I believe at the Fed, any given Fed, there's a separation between the monetary analysis and regulation, and critically here, supervision. I have to admit, I've been appalled the last couple days at the lack of focus on bank supervision. This idea of going after Jamie Dimon, you mentioned this buy rating on JP Morgan as we go to earnings, or going after Brian Moynihan, and that's going to solve the banking crisis. It's just baloney. Absolute baloney.
A downgrade for JP Morgan this morning.
Sorry, I segued there.
That's okay.
Excuse me.
Neutral.
I'm busy.
Neutral.
I'm busy sending out
plenty
tweets
of buy
on
ratings out there, Tom. If you're interested.
I'm not focused. I'm sending out. Sending out tweets on my Red Sox special.
So you're done with Threads
at 9:30.
You're done with Threads.
Done with Threads, and
okay.
I learned last night. Vet Bill had to teach me how. I actually learned how to delete an Instagram account.
Right.
They make it so hard to do. It's just a conspiracy.
So you were in conversation with the dogs last night?
Oh, yeah.
A few drinks.
After.
Just,
doing research.
Okay. Equities right now on the S&P, positive 0.2%.
Yeah, they get the olives.
On the S&P 500. I'm sure that's true. Yields lower, Lisa. We're down 2 basis points. The 10-year, 394.83.
So if you're just joining us now, it is CPI Wednesday, and we are expecting that CPI report at 8:30 a.m. Eastern. Core CPI will be key, how much it's coming in, not expected to come in as much as the headline number. Will it be enough? Will it change the conversation at a time when Fed officials want to remain as hawkish as possible? 10 a.m., the Bank of Canada has been a leader so far this year. It was one of the first to do a hawkish pause earlier this year. Then they reversed their steps and raised rates. They're expected to raise rates yet again to a peak of 5%. It's supposed to be the final rate hike of the cycle. Very curious, though, at the 11 a.m. news conference with Governor Tiff Macklem, what they say going forward about what their threshold is to know that they have achieved victory, as the British do, evidently, if you listen to Tom.
Brits getting a hard carpet this morning, aren't they?
Well, I'm just following on to our fearless member over here. And today, a stream of Fed speak. It really is dramatic after yesterday's quiet.
Are you kidding me? 5?
Richmond Fed President Tom Barkin at 8:30 a.m. Minneapolis Fed President Neil Kashkari, joined by ECB Chief Economist Philip Lane at 9:45 a.m. NEC Director Lael Brainerd, who also was former Fed chair, she will be speaking around midday. Atlanta Fed President Raphael Bostic, he has been the lone dove. I think this is really interesting. He's the one saying, I think we've done enough.
Goolsby's not a dove?
Keeps coming out. Not as much as Raphael Bostic. He has been really the most extreme on that
More than
front.
Goolsby?
More than Goolsby.
Wow.
That's what we've been hearing from him. Goolsby has been more on the edge. We need to see. Raphael Bostic has been more definitive about perhaps remaining on hold. That comes at 1 p.m. Just wait. There's more. Cleveland Fed President Loretta Mester speaking around 4
How
p.m.
exciting.
Dr. Brainerd must get a first look at inflation. Like, before she speaks, she's got to know. Do the others know what the numbers are? Before? I mean, Kashgar's going to be, damn, I got to rip up my speech.
That sounds like a Mike McKee type question,
yeah.
to be honest with you. Ask Mike.
He's out in the Rocky Mountains, right?
Have you seen that? I caught up with him earlier this week. There he is. Nice cabin.
We're here, like, you know, it's
wood fire. You know, just beautiful.
Love it.
Oh,
he's getting geared up for Jackson Hole.
So what am I doing here? Just go and do that.
He just,
I'm only doing Fed days from
Guess he'd rather
now.
be in Colorado.
It's that song. Who sings that?
This is a John Denver song.
Oh, this is
Mary
nice.
Chapin Carpenter kills it.
Like John Denver.
Kills it.
Nice.
It's about a guy on Wall Street, a British lad on Wall Street, who's wasted on Park Avenue. And the British lad on Wall Street would go, I guess he'd rather be in Colorado.
Nice.
I guess he'd rather work out.
We are live, you know. It's not a commercial break anymore.
We're not the dogs either.
Take a listen to this. Year to date, the S&P up close to 16%. The NASDAQ up more than 30%. That's the NASDAQ composite. Then take a listen to this line from Morgan Stanley. The bear market's not done yet. Dan Skelly, head of market research and strategy at Morgan Stanley Wealth Management. Dan, gains like that, and you guys are saying the bear market's not done yet. Dan, tell us why.
Sure, John. The market to date has been incredibly stronger than we had expected, as you mentioned. We are still in an environment where we think earnings are going to come under pressure as inflation and wage costs stay elevated and growth slows. And let's face it, the starting point in this cycle was stronger than we and many had expected, given consumers and corporations took advantage of low rates to refi balance sheets in 20 and 21, given high fiscal spending. And I think also given a high degree of pricing power. And as you know, our team has talked about the idea that, and we're already seeing this in many of the lower quality areas of the market, in a world where inflation and growth is slowing, pricing is going to be difficult to maintain forever. And so to be fair, and to your question, the part of the market that has not yet seen that lapse in pricing is the high quality mega cap space.
I looked in, Skelly, at the idea of a bull market coming out of October, third week of October last year. And there's all this silliness from the, our childhood about an intermediate trend in a bear market or an intermediate trend in a bull market. Are you people reaffirming a bear market, or are you reaffirming an intermediate bear market trend within a bull market? Which way is it?
So more of the latter, Tom. And, Mike Wilson has talked about this idea that he first published on 2 years ago about a cyclical bear within a structural uptrend. And the cyclical bear had two phases: fire, which was the idea that valuations had to adjust to higher rates in the Fed. And that played out to a T last year, and ice. And again, going back to the ice part, the ice has taken longer to manifest because the stronger starting point of the economy, stronger starting point of the consumer, and again, at the mega cap level, higher pricing than we had anticipated. You're seeing pricing deteriorate for like the bottom 400 companies in the index. You're just not seeing it as aggressively just yet in the top 100. And I guess the last point I would make is, given where values have gone, it's difficult for us to chase or change the view at the moment at 20 times earnings. If you've gotten to the point where earnings have bottomed or flattened out, which is what the market is essentially saying, typically when you look back 40 or 50 years, the market multiple does expand in advance of that. And this time around, it's been 20 times. And over 40 or 50 years, the average is 20 times as well. So you really need to see the hockey stick into 24 to get the market to go further from now, right? 245 is the expectation in 2024. And we just think that's going to be difficult to come by.
Is it getting harder, Dan, to be cautious?
It certainly is. We're certainly being tested, and that's happened over cycles before. I think that the idea that the market has said this is a good pause, the Fed is eventually, maybe it has one left in July as the market has priced, and maybe there's more to go as the Fed has said. As you know, there's a discrepancy there. But when you look at history, there's 5 instances of a good pause, and they're 85, 95, 97, 06, and 18. Those were scenarios where the market said that the Fed pausing means we've done enough to fight inflation at the time. But when you look at the macro data at those instances, there was the complete inverse of today. When you look at the macro data of those instances, the yield curve was positively sloping, credit conditions were loosening, inflation was much lower than today, unemployment much higher, and leading economic indicators were accelerating, not decelerating. So you're right, it continues to be difficult to stick to this story, but all of the history and all of the rationale that we're seeing does support it.
What would it take, Dan, to change the story, to change the thesis, to actually become more constructive at a time when the economy does seem to have ongoing strength that has defied all expectations?
Well, the economy is slowing. If you look at the path of real GDP, Lisa, last year, 3.5 to 2.5, now closer to 1.5 or 2. Jobless claims are up 30% off the lows of the last 6 months. So you would need to see the economy reaccelerate and see that 245 earnings pictures being more probable next year, number one. And then amid that, a lot of people think we're going to have this reacceleration or this, ramp up with inflation also going to 2%. So that's the disconnect that we still find to be somewhat anomalous and somewhat contradictory. And here's the thing. A lot of levers have been pulled, Lisa, as you know, to go from 9% peak in June of 22 to 5% core today. And that includes money supply collapsing and going negative after it exploded during COVID stimulus, China reopening in June of 22 and goods pricing and supply chains improving, and oil and gas 30% lower than its its Ukraine invasion highs. So think about that. That's 9 to 5. I'm not sure, and the firm is not sure, that there aren't other issues out there that are more structurally related to inflation being stickier, i.e. shortages in labor and shortages in housing. Last thing I'll say is related to this idea of the market having its cake and eating it too. We and many have said residential housing has bottomed. So think about the potential inflationary effects of that from a first order and second order effect. So again, we think it's going to be difficult to get to that higher earnings level. And if we're wrong about that, we also think it's going to be difficult at the same time to not see rates and inflation impede multiples at 20 times.
It's been difficult to be bearish this year, that's for sure. Dan, appreciate your insight. Thank you, sir. Dan Skelly of Morgan Stanley Wealth Management. Very upfront, honest, transparent about what a difficult year they've had, so far at least. Tom, 6 months through it.
We're not through it yet. I mean, I think what Mike Wilson would say is, it's been a challenge 6 months, but it can reverse on a dime if you get the kind of scenario that they've laid out. Most of strategy, John, is scenario analysis, where there's probabilities. And, you get out on the wrong side of it, way out on the wrong side of it, and that's where you get into trouble. But
yeah.
And to be fair to Mike Wilson, I think he's been very probabilistic about it. He hasn't said it's not the sophomoric certitude.
If you are just tuning into the programme, welcome to the programme. Equity futures right now on the S&P positive 0.2%. Coming up very shortly, David Kelly of JP Morgan Asset Management. We'll catch up with him in the next hour as we count you down to the CPI data point, Tom, 1 hour, 17 minutes away.
It's a huge, huge deal. And David Kelly is one of 2 people I will ascribe to the idea, are you ready for sub 100,000 or even a negative non-farm payrolls report? Yeah, I think he would say December. We can ask him.
Oh.
But we're not ready for 2% inflation. We're not ready for the Kelly non-farm payrolls scenario.
Will we get a 2 handle today on headline CPI? Most people are looking for something with a 3. Coming up shortly, 7:30 Eastern Time. Gene Tenuto, Columbia Threadneedle. We'll catch up with him. Coming up in about 16 minutes.
It is a merits-based process, and we see the enthusiasm and the intensity with which Ukraine is reforming and thus advancing rapidly towards EU membership. So I'm very confident that if they keep on going, keeping this speed, that success will be there soon.
Ursula von der Leyen, there, the European Commission President, on a situation with Ukraine, the potential for EU membership. We'll head to Lithuania in just a moment. We'll head to Mike McKee a little bit later on today as well. We've got to talk about the economic data, which drops in about 1 hour and 12 minutes' time. Going into all of that, the scores look like this Wednesday morning. Positive 0.2% on the S&P. Two-day winning streak on the S&P could well become 3. The fate of that might be decided early on by the inflation report just around the corner. That two-day winning streak followed a 3-day losing streak on the S&P 500. In the bond market, yields a little bit lower. We pull back. We're down 2 basis points on a 10-year, 3.95 on a 2-year, Tom. Let's call it down about a basis point or two to 4.86.
But I think a real adjustment here, 1 hour away from this, I think it's a real statement after the quiet of Monday and Tuesday, John.
Yeah. Snooze, you would say, Monday, Tuesday.
Tuesday, big time.
Snooze.
Monday, even less so. Tuesday was a snooze fest.
It was a nice summer
Except
Tuesday.
for NATO. Except for
nice,
Anne-Marie
well, we're
and
not
Maria.
talking about foreign policy. We're talking about markets and economic data.
Like
yeah,
pause.
you know, it was nice.
It was a pause.
Well, you should rest, relax. That's what
I'm
summer's
watching
for.
futures here. They got a little bit of a lift, though, John.
100% agree.
Thank you.
Oh, thank you. Well, it's okay. First time today we agree. We agree that it's good to talk in Lithuania to Anne-Marie Horton, our chief Washington correspondent, and also Maria Tadeo, our chief Europe correspondent. Maria, let me start with you, and thank you so much for letting me know that the giant of Czech literature, Milan Kundera, has died at 94 years old. Everyone says he should have got a Nobel Prize for the unbearable lightness of being and the rest of it. He personifies a Europe of another time and place, of the fractious dissidents along the frontier. Has that frontier been shattered? Has Putin shattered the frontier that was the distance from the Czech Republic to Germany?
Tom, that is the hardest, toughest question you've ever asked me, because I don't think I would even qualify to talk about the genius that this man is and his literary legacy, obviously, that he leaves behind. But to some extent, you could argue there is a parallel here, and it's this idea of what perspective. At the time, he talked about Central Europe and the influence. He described and talked about a Bolshevik civilization and Soviet influence on the region. Here, it's about Ukraine, and it's about that shift from the Soviet sphere to now becoming the West. And the message from NATO is that you're not formally in it, but you're moving closer. Then we get into the linguistics here. But for the Ukrainians, that perspective is crucial, that signal. And this is why President Zelensky was infuriated yesterday. The tone changed. But for them, this idea of perspective and where you belong in the world really matters. And that speaks to the genius of Mr. Kundera, too.
I mean, Anne-Marie Horton, this is really germane, you know, not so much on Milan Kundera, but, you know, my childhood was Tito in Yugoslavia and the dynamics across Eastern Europe. That seems to be ancient news and shattered. Anne-Marie Horton, what does the White House think has replaced those relationships on the Eastern Front?
I think they're replacing those relationships. What you've seen is more of these former Soviet Union countries part of NATO or wanting to become NATO, like Ukraine. That is the biggest discussion here today. We just heard from Zelensky speaking. But what you are seeing is a more fortified, united front in Eastern Europe. Now you have this really uninterrupted NATO force from the Baltics to the Black Sea. And that is obviously a concern for the Russians and something that they do not want to see. And especially when you're hearing today Zelensky having this reconciliation, if you will, compared to his scolding yesterday on Twitter when it comes to the West. He's saying that, of course, we know that some are anxious and worried to come out and talk about the fact that Ukraine at this moment could be a part of NATO, given there's a war there. He said for the first time today, he does feel like he has given that recognition that one day it would happen.
What we've seen overall from this NATO meeting are a couple of different threads, whether it's Ukraine on one hand, whether it's the internecine European debates on the other. And then there's a question of Turkey and how it suddenly has entered into the front of everyone's mind. Maria, from your vantage point, why is it that Turkey's Erdogan seems more amenable to a more friendly relationship with the West?
And we don't even know if he actually wants a more friendly relationship, because ultimately a lot of this, when it comes to Sweden, for the Turks is transactional. We know they won the planes, and the Americans, they say they're not connected, but the Turks say there is an implicit connection there. I think also when you talk about Erdogan, and we say, what does President Erdogan want? What does he mean? We also should always focus on the idea that he speaks to a very different audience, and he speaks to a very multidimensional audience. He talks to, obviously, the Turkish people, and it's been great to dominate the news cycle. He can present himself not just as the election winner, but really as a big international player. He is right there with President Biden. He's one of the strongest voices here represented. He was the star of the show. He also talks to the Muslim world. He was very specific about the idea of faith and burning the Quran, and incidents that he said should not happen in Sweden. That is also a public that he speaks to. And then you have the investment community. We have to wait and see what the central bank does. But obviously we know this is a country that needs now investment, that needs international investors, and maybe there's something for him on that too. But I think, again, it is too early to tell whether this is a transactional shift in NATO or there's something that is medium term that is changing in the country.
And Marie, fast forward to next week. How is President Biden going to spin this? And how is he going to talk about what actually transpired in NATO to generate some perhaps greater popularity?
Well, I think you're going to see that on display this evening. The president, local time this evening, your afternoon in the United States, the president's going to be giving what the White House is billing as a major address. And I think it's twofold. One is that they want to continue to make sure that they are holding this consensus within the NATO allies, within Europe, as obviously Putin still has his aggression in Ukraine, and also making sure they're showing their support for Ukraine. But at the same time, they want to show to the American public that what they view, and their argument is that Biden's foreign policy has been successful. There's also many Republicans who would agree that they have been successful. On this trip in itself, you not only have this consensus around NATO, they were able to get this wording where they all were able to agree about the path forward for Ukraine, even though some wanted a little bit more of a emphatic direction for Kyiv. But they were able to expand NATO. And I think then tomorrow it's going to become even more apparent that what this White House is trying to do. When you look to 2024, at the moment, everyone would argue that this is going to be, given the polls, another matchup between Trump and Biden. And what you're going to have tomorrow is an American president back in Helsinki, but this time it's not to meet with Putin. They're going there just to have a meeting with the Nordic countries, with Finland's president. It is a victory tour for this president. And I think what they're going to try to contrast is the last time a U.S. president was there was when Trump was there. And obviously we all remember his comments regarding Putin versus his own intelligence services.
I've got 30 seconds left. A lot's happened in the last 24 hours, Anne-Marie. Yet some people, their takeaway of the last 24 hours might be that the president didn't attend dinner. Does this administration care about optics?
Well, I think they care less about optics than, say, the former administration. It is not unlikely. It is pretty much a status quo that Biden does skip dinners. They view that what they're doing on the ground is substantive, and some of this optics stuff not exactly necessary. They're really excited about the major speech he has to give today. Potentially that was some of the prep work he did last night. He also was dealing with floods that are happening in the Northeast, in Vermont, but is not unusual that Biden just decides to skip dinners. Now, will that hurt them in the polls? It's leading the Drudge Report today. It's obviously on top of mind, the headlines of the New York Post. Potentially, the messaging will be misconstrued for what they want to show as a major achievement here in Vilnius.
Yeah.
But really, American people are just seeing that he missed the meal.
AMH, Maria Tadeo, thank you. Politics is amazing, isn't it? You do all these crazy things, important, sometimes controversial, and then the focus shifts to who went to the dinner in the evening.
Social media.
CPI data, 60 minutes away now. Going into it, the scores look like this on Wednesday. Equity futures positive by 0.25% on the S&P, up by 0.3% on the Nasdaq, on a Russell up by 0.6%. That's the story at the index level. Bramo's got some individual stocks for you in just a moment. In the bond market, 2-year, 10-year, 30-year, let's slice up the yield curve. 2-year, 486. 10-year 3.95, yields coming in just a basis point or so. We've been retreating on a 2-year yield going into inflation ever since we got that big upside monster surprise out of the ADP report, and we printed a new cycle high on a 2-year of 5.11. All the way back down to about 4.85. Came close to, I think, 4.82 in the last couple of days. In the FX market, bit of dollar weakness emerging, developing over the last few sessions, Tom. 110.20 on the euro against the dollar.
And combined with the yen, I'm watching euro-yen to see which way the dynamic is on euro. And yen has a tendency here to stronger yen versus euro in the last couple of days. But, you know, there's a whole stew to this, and I'm going to go to dollar Mexico. I can't, when I look at the screen, my eyes miss the Mexican peso because it's 17.02, not yet printing 16.9x. John, that's unimaginable to see a Mexican peso that strong.
5 days of US dollar weakness, longest streak going back to March. Bramo, that just developing over the last week or so.
Yeah, it's been a really interesting trend in the dollar sphere. What I'm looking at in the single names, on one hand, you could say Tom is not totally wrong. It's a little bit snoozy. Coty, perhaps the biggest mover because of Kim Kardashian. It's gaining nearly 4% after the Wall Street Journal reported that she is in talks to buy back the minority stake of her beauty company that she had sold to Coty 3 years ago. This was, according to people familiar with the matter. Okay, that's an idiosyncratic story. Rivian, fascinating because it's up 85% since June 26th. It gains again ahead of the open here, up more than 1%. And I put Snap here because I was looking for an example of the memification of the market, of the meme stocks. And those shares are included in the meme index that some people look at. And they're up nearly 2% in pre-market trading. Meme stocks are up about 10% over 3 days, even as you have consumer staples down. And I'm looking right now at how much you've seen that increase. How do we then parlay that into a market call at a time when people previously viewed that as froth? And now suddenly is it different?
I'm really glad you bring this up because it is, like everything else, getting out front of what's perceived to be a disinflationary shock.
I remember when 5% rates would kill all of that, Lisa. Do you remember that?
Yeah.
I do, and that's not causing it anymore. And that's the interesting thing. You've seen this rally in a tremendous vacuum of any sense of easing. And so is this real? Is this all of a sudden that, you know?
No, it's never real. It's the markets. The markets, you know, they're just expecting out. And there's been a sharp shift in the last couple of days.
Is this philosophy with Tom Keene? Nothing's real.
I just, you know, with the death of Milan Kundera, I'm just very, sensitive.
You're feeling the unbearable lightness of being?
Yeah, I'm unbearable. We know that.
Can you get me off the wide shot? Just I don't know what's going on this morning. TK CPI, 1 hour away. Gene Tenuta of Columbia Threadneedle.
I was going to say
writing this. In the second half of the year, we think there is a strong case to be made that inflation will continue to fall and end the year below the Fed's forecast. This should help reduce interest rate volatility and be supportive of bond prices. Tom, Gene Tenuta, Columbia Threadneedle.
And joins us right now. Thrilled that he could give us a brief here this morning. It seems to be in the air this morning, Gene Tenuta. How rapidly does this occur? Like if I look at the Bloomberg Total Return Index and I see price up, yield down, is the Columbia Threadneedle vision 6 weeks, 8 weeks, 8 quarters? Which is it?
Yeah, I think we're taking a little bit longer term view here, Tom. And if you look for the next 6 months through the end of the year, I think there's a reasonable case that as inflation continues to ratchet lower, that we get the Fed to have the confidence in that pause. And that can really push bond prices higher. And I think, you're looking at returns on the Bloomberg Aggregate Index this year that are pretty paltry, a little bit over 1%. And we could see that in the 3 to 5% range as we get into the fourth quarter. I don't think that's a stretch. I think what we have to appreciate is the fact that the Fed now, in their summary of economic projections, has an inflation forecast that is beatable, and inflation could surprise to the low side. That'll be very supportive.
I mean, on a duration basis, is the market, is long-only buy-side pension plans, more conservative, big money, are they under duration right now? Is there a huge, almost short cover to be had as everybody staggers out to the Tenuta view?
I think there is room for that. I think a trend over the last 18 months has been don't fight the Fed. The Fed's hiking, they continue to hike, and active managers have been underweight duration or positioned in shorter maturities. And that's understandable because, frankly, in the bond market right now, our biggest competitor is cash or CDs or deposits because short-term interest rates are high. But when they stop going up and there's a more visible propensity for longer-term yields to go lower, I think there's a tremendous opportunity for long-term yields to go lower and really see that price appreciation in fixed income.
There's a tension this morning, Gina, and it's been here for a couple of weeks now. Can we see some sort of rally in credit in stocks if you do get this ongoing disinflation, if you do get a reversion to an inflation rate even below the Fed's targets, as you've been basically pointing out and expecting? Do you see credit as holding up and doing well, or getting punished because of weakness that would have to accompany that type of move?
I think there's a distinction here between the stronger balance sheets and sort of the weaker hands that maybe can't withstand a more rapid growth environment. I look at the investment grade universe and I'd say very confidently, absolutely, they can withstand that slower growth, slower inflation environment. We have cash flow and EBITDA levels that are stronger than they were pre-COVID. We have the lowest leverage levels of the investment grade market that we've seen in over 5 years. So absolutely on the investment grade side, particularly with I would say the encouraging degree to which the large cap banks have come through the regional banking malaise of the last 2 quarters. On the high yield side, I'd say it's a little more divided where, you know, the higher quality companies we think can do well. They continue to maintain strong market positioning. But those CCC rated companies, it's very likely that defaults start to increase. That's very common at the end of a tightening cycle after financial conditions have increased. And in a slower growth environment, that's where they're going to struggle.
So even though we do potentially have a more likely soft landing type of scenario, you still see some risk for the lower rated credit. What do you say to people like Torsten Slog, who still does think that recession is the base case, that a soft landing seems highly unlikely, who said this morning that usually the monetary policy transmission takes 12 to 18 months and we're just not there yet?
I think there is a long and variable lag to tightening of financial conditions into the real economy, but it's hard to argue that the first half of 2023 has been a soft landing. That's exactly what we've seen. We've seen low and positive growth. The unemployment rate still starts with a 3. And so the economy is in pretty good shape, even though growth is slow, but inflation has been coming down. I would look at other economies around the world and say he's absolutely right. And we're seeing much more risk of a hard landing, particularly in areas like China and also in Europe. And so those are areas we are concerned about. And we have to be very careful on those regional differences right now.
Gene, in your research note, and this is, really technical, you talk about mortgage-backed securities being the place to be. How does the challenges of commercial real estate fold into our listeners and viewers trying to just buy yield? Does commercial real estate, is it germane to your analysis?
I think we have to split those things in two, Tom. In particular, what we think are attractive are residential mortgage-backed securities, those guaranteed by government agencies. So the credit risks associated with commercial real estate are really not embedded in those securities. What you have there is the benefit of higher yields coming from the Fed that's been raising rates and higher interest rate volatility over the last year or so. So that gets you to a point where those residential mortgage-backed securities are yielding or have a credit spread on par with what we see in corporate bonds. Now, on the commercial side, we are very conservative in that area, particularly on the office sector. We think there's more pain to go, and some of our analysis suggests that fundamental valuations of these commercial properties need to come down by 30% or more in order to be at an equilibrium level. So we remain cautious on the office sector within commercial real estate, but would definitely differentiate where we see strength and opportunity on the residential side.
Tom writes in from the left side of the desk and he asks, what do you do on a really slow summer, right? The idea that we do have a sort of lull in real news. We are going to get something starting on Friday with respect to earnings. We do get CPI, but do you take a breather? Does everyone just sort of try to lobby for working from home and take time off?
I think a lull is okay, Lisa, in the bond market. Yields are a lot higher now. And I look at high quality yields in the 5% area, high quality, high yield. You can earn a 9% yield on, 0 to 5 year single B assets, double B assets. I think a lull is okay. And we don't need price appreciation. We can earn our income. And those are equity-like returns when I'm not sure how much more the equity market has to go here.
Gene, it's been great to have you on. The only reason we booked you today is the understanding of Columbia Threadneedle. John Threadneedle, of course, you know that Bank of England, London.
Sure.
Columbia is a venerable Boston firm. And Ted Truscott, who put all this together for Ameriprise, he has the best seats at Fenway. I mean,
Is this another tease for your franchise?
Ted Truscott is a Middlebury lad.
He's not going to watch.
And he pulled strings. This is ages ago. Truscott with the
Gene, bear with
Yawkey
us.
family.
Tom's about to promote a show that he's done that airs tonight that he's not going to watch because he's going to be asleep, but he wants everyone else to watch it.
But
when does it air?
It's at 9:30 tonight on
Right.
television and radio. I'm not sure what they're doing, but the fact of the matter is Ted Truscott out of Middlebury has the best damn seats at Fenway of anybody in town. I mean,
Can
the
you watch it
rockstar
in the
seats.
UK?
I
Or in
think so.
Europe?
Yeah, on
Okay.
YouTube. We have people, thank you for watching on
Cool.
YouTube. John and I and Lisa are working every day on our YouTube franchise.
Nice.
As they say.
Do you want another promo or are you done?
No, I'm promoed out.
Gene, thank you. Gene Tenuzzo of Columbia Threadneedle. 9:30 Eastern Time. Judy Swinehart, right?
Julie Swinehart.
CFO,
It's an
Fenway.
amazing. She's a
Cool.
real estate CFO. Like she's total math nerd. And they call her up. She goes, "Who's the Red Sox?" She didn't even know. She didn't know what Liverpool was. They own the Penguins too. Hockey.
Oh, nice.
Sydney.
Nice. I've been distracted by reading about milk in Wisconsin. Really going
That's
down a
serious
rabbit hole
stuff.
on this.
Yeah.
It's really interesting.
Milwaukee Metropolitan Sewerage District wastewater treatment system handling huge volumes of milk.
Yeah.
6,000 to 7,000 gallons. 50 trailers a day. 50 trailers a day, Bramo. Just going down the drain.
Occasionally, this has become a real problem when they have an oversupply. And then it's the physicality of a good at a time where that matters. How do you store it? What do you do with it? Do you just get rid of it?
Where's the Wisconsin of England?
The
Like,
cheese
is
maker
there,
of
is
England.
there like a place where there's just
I don't think there is
cows?
one. Tom, like number...
They're sheep.
If Wisconsin was a state, it would be the number 4 cheese producer on the planet. 90% of that milk goes into cheese. Last 10 minutes has been fascinating. I've got no idea what Gene Tenuzzo said. Don't know what Gene said.
You should come out
John,
with me and meet
you're
my
looking
family.
at somebody. My mother was so bad. I thought Velveeta was gourmet
Stay
cheese.
tuned
It
for
was like,
special
you know,
coverage of cheese. If you are just tuning into the programme, welcome. Equity futures up by 0.3%. You want to talk more about cheese, or we're done? I think we're done.
Yeah, well, Velveeta,
I could go
I
all
think
day.
it's, something.
I can tell you what's coming up.
Mondelez.
If they scroll, I can tell you what. There it is.
There
This
it is.
what's-
Nailed it.
saved.
Simon, thank
Saved.
you for that.
It's the only time I want the prompter just for the tease. There we go. Bill Dudley, former New York Fed president, coming
It's
up
an important
in
conversation.
about 30 minutes going into CPI. That'll be cool.
And the disinflation will push against that. The disinflationary trend will push against the Dudley view.
And milk? Where does milk fit into this?
You'll have to ask the gentleman from Berkeley. What's sick is Bill
You
Dudley
reckon
will have an
Bill's-
answer.
Bill's got something to say, Bramo?
Have you ever had cheese curds? And they've got cheese hats in Wisconsin.
Okay,
and
well, this
that's
is your
actually
home
really
state.
big.
This is your home state.
I've got a lot of family in Wisconsin, and
You're
go
way
and you
more
milk a
Wisconsin
cow.
than you are New York. Let's be honest about that.
You mean because I seem like farm girl, and you guys
Yeah, totally.
joke about that
Yeah.
all the time, and just
Well, Tom more than I
family.
do.
Yeah.
Tom-
But there's
Tom
an
more than
element
I
of truth to it. It's fascinating because it's the economics of the physicality of goods versus the asset inflation that we talk about every day. And physicality of goods is complicated.
Smart. We should have done a segment on this.
Milk like they used to?
Are they doing what, Tom?
Are they drinking milk like they used to?
Personally, I'm an almond milk kind of guy.
Really?
Are you just sensitive
I like
milk?
almond milk.
Really?
I like
Is it
Not
like
in my
sugar?
not in my coffee. No, you can have it unsweetened.
You can have unsweetened.
Unsweetened almond
Really?
milk. Yeah.
Is it good?
It's not. It's for protein shakes and stuff. It's like a base for smoothies.
Oh, it's a base. You don't drink it just so. No, you don't.
No, it tastes nice. It's not bad. You can have it with oatmeal or porridge, as we might say back home. You can have it with some oats. That works too.
Full fat milk.
This show's
All about
great
it.
this morning.
It's so good.
We're just killing it.
Inflation data coming up.
Inflation itself is getting close to bottoming this cycle. We think it's going to be very difficult for the Fed to get inflation below 3%.
If the inflation rate bottoms at 3 and starts drifting higher, the Fed's going to find this unacceptable. And that 2 rate hikes that we have priced in for the rest of the year will happen, if not 3.
Great guests over the last week. Tom Titouris there of Strategas, Jim Bianco of Bianco Research on the outlook for inflation. As the outlook, the actual data drops in about 44 minutes' time. Going into it, the scores look like this on the S&P 500. We're in the green here, slightly positive by 0.2% on the S&P. There's a lift across the S&P, the Nasdaq and the Russell. For futures going into the opening bell, a couple of hours away. In a bond market, yields backtracking down about 3 basis points on a 10-year to 394.23. TK not talking about the market in the commercial break. TK talking about Barbie and a movie.
Barbie the movie. I'll do it with Paul Sweeney in the 9 o'clock hour. He's expert at this, but I have never seen a summer hype on a combination of Barbie, Barbie, Mattel, Pink, and all that, and something as serious as Oppenheimer and the development of the atomic bomb. It's bizarre.
My old producer, now features writer for Bloomberg, Sarah Rappaport, calls it Barbenheimer. Barbenheimer apparently is the phrase, because a lot of people are going to watch Barbie and then they're going to watch Oppenheimer at the same time.
That's
back to
nuts.
back.
Drink
Who would
chaser.
do that? Exactly.
Yeah,
That's essentially what it is.
that?
Can I just say that we've gone from milk storage from Wisconsin to Barbie,
Sure.
and it's
Why not?
Happy Wednesday.
Mission Impossible Saturday, that's what I'll be watching. There you go.
Oh, does that come out Saturday?
That's come out this week.
That's very
Yeah.
good. Yeah.
Okay.
I haven't seen. Is it like Mission Impossible?
You've never watched that, have you? Well,
No.
you haven't watched that, 2 or 1. So
I did
4, 5,
watch
6.
Matt Damon
He will
was
watch
saving
Barbie, though.
somebody.
100%.
TK doesn't watch movies.
No, I don't.
Hasn't watched Gladiator. What else haven't you watched? There were some big movies
I did
you
see
haven't
Gone
seen.
with the Wind.
Never seen Top Gun.
Never seen Top Gun.
Never
That's
seen
true.
Top
That's
Gun.
What about Barbie? Are you going to see it? Honestly.
No, are you kidding? I don't have the time. But I'm fair. I mean, Will Ferrell, I'd go see anything. I did see Talladega Nights, and
Good
that was
movie.
spectacular. The dinner scene at Talladega Nights was lights out.
How about Anchorman?
Nope, haven't seen it.
Oh, okay. Frozen.
Somebody didn't make it.
How many times you watched Frozen?
Frozen, I've seen 400 times. Jeremy Stretch here to save us right now as we go through your movie review. Jeremy Stretch is in London, surviving the visits of the president with King Charles. Jeremy, serious question here to this raging debate of inflation. To a pro like you, what does the U.S. dollar say about the disinflationary story? Do you look at your Bloomberg and say, okay, the FX markets say this about where inflation's going? Can you do that?
Well, I don't know whether you can do that specifically, Tom, but I think what you can say in terms of today's reading is that the market seemingly is very much of the opinion that we are going to see a benign CPI print in terms of the most recent data, both in terms of headline and core. But I guess the question is not just about where we go in terms of this absolute data point, but I think in terms of one of your other talking heads, the base effects which are so beneficial for the headline CPI print today will prove to be much more challenging in the second half of the year. And I think that's going to be the difficulty that the Fed is going to find, is that those base effects will preclude inflation on a headline basis falling quite so dramatically in the second half. And that's probably going to keep the pressure on the Fed in terms of not only this meeting, but also the next one as well.
John, I'm too rattled here as well. Jeremy, you've got to learn this. There's only one talking head, and that's me. I'm the talking head here within Bloomberg surveillance. I mean, I'm reminded daily by Bramo and Ferro that I am the talking head. Do you want to pick it up here, John?
No, I don't. I'm so deeply offended by Jeremy that I don't want to talk to him. Bramo?
Jeremy, save us. We've been talking all morning about the persistent weakness that we've seen in the dollar and how that really does come to an expectation that we're going to have some plateauing and some real disinflation heading into year end. Where is the positioning around that trade? Does that confirm the likelihood of a continuation of this weakness?
Well, I think when you're looking at dislocation in markets in terms of positioning, obviously one of the big dislocations is very much in terms of dollar yen. So we have seen positioning really looking stretched in terms of real money positions back to extremes that we haven't seen since 2018. So we're seeing some degree of relocation or reorientation of those yen short positions. So I think it is going to be the case that I think there is still a story or a presumption of a weaker dollar into the end of the year. But I think it's still a debatable one whether we should necessarily just extrapolate this move lower that we've seen in the course of the last few days through the summer period. Because, as I say, I think there is still a residual risk that we do see more than one Fed hike from here. We at CIBC looking for 2, and including both July and September. And September is not really priced in any meaningful form. And so if the data starts to suggest that that is a mispricing, then I think some of that positioning dynamic in terms of the dollar will still keep the greenback relatively firm across the summer, and it's perhaps a Q4 story when we will see a more obvious weakening in terms of the U.S. currency.
38 minutes to go to that CPI report. Jeremy, based on market positioning, based on what we have seen, what's the bigger risk right now, an upside or a downside surprise to FX markets in terms of the CPI report in the U.S.?
Well, I think because everybody is going in with the presumption that CPI is going to be very benign, when you look at things like those used car indices, which are suggesting a big reduction, then I think a CPI print in line or even a tick or so higher would be a much greater surprise and much more painful. So obviously, you touched upon the retreat that we've seen in U.S. yields from the extremes that we saw after ADP last week. So I think in the context of an inline or a tick higher in terms of CPI, I think that will be the far greater surprise for the market today. So I think it could well be a classic case of buy the rumor and sell the fact.
Where's the best speculation right now, Jeremy Stretch? Seriously, which pair offers the best big figure opportunity?
Well, I think in the short term, it is very much the case of looking for yen positioning. I think there is still a good case to be made that as we move towards the BOJ towards the end of the month, there is scope for further adjustment there. I think the other currency of particular note of late is somewhere like the Norwegian kroner, where not only are you getting the oil-inspired influence, but of course you also had that CPI print earlier in the week. So I think the NOK also is providing some scope. And I think in terms of sterling, there's a little bit of interest because, of course, we have seen very good sterling performance over the course of the last 3 months. And I think sterling will remain supported until the cracks in the real economy start to be seen. Those cracks are still very small fissures at the moment. So I think it's still the case and the opportunity still for some degree of sterling positioning as well. But I think over time, it may well be that crosses like sterling yen could become particularly interesting.
Jeremy Stretch of CIBC, thank you. You two can't keep it together.
Thank you.
We've got an IB on Bloomberg. Every now and again, Bramo throws in a thought. Listen to this. I mean, I can't. Are you serious? Barbie is actually fascinating for how Mattel is broadening its image and business concept. What are you talking about?
How many Barbies did you have as a kid?
Oh, I didn't have Barbies.
You didn't have Barbies.
I wasn't allowed to have Barbies, which explains a lot about me.
You were not allowed to have Barbies.
No, I was not. And honestly,
what does that mean? What does that mean?
Mattel is a toy company manufacturer.
Okay.
All of a sudden now, they're a content producer, and Barbie is IP, and that's a fascinating transition to create a new image. I think this is interesting.
All right.
How's the cheese doing?
Can I
kick you out of this group chat
Since it's Segui Wednesday here, 35 minutes to the inflation report, can I do a Segui, John?
Sure, do some tennis. Go on.
You're way more up to speed on than I am. This is exciting. It's a kid literally out of nowhere picked up by Georgia Tech who has dazzled them in England. This is Mr. Eubanks. And maybe it's somewhat akin to what Emma Raducanu did. I'm not sure, but this guy's in the quarterfinals. Tell me about this guy, John. He's like the real deal.
6'7", I think 27 years old, Tom. And I would say he's a late bloomer compared to the likes of, say, Alcaraz, who's playing also in a quarterfinal today. And he's in a quarterfinal with Danny Medvedev over at Wimbledon today, Tom. And good luck to him. I think the only US singles male player left in the draw.
Yeah, and it's hugely rare to be this unheralded in the draw, right? What are your thoughts on this? You got a shot?
Oh, you want me to give my thoughts on who's going to win?
Well, Lisa and I have no clue. Lisa's trying to buy her first Barbie.
You've got on the one side of the draw, the Spaniard, Alcaraz. On the other side of the draw, Novak. And I don't think anyone else has got a look in.
There you go. See?
Heard it first here.
That's my take. Here. I mean, I think most people would be on board with that view.
I'm just doing the tennis up.
I hope we get some upsets, but unlikely.
Do you have
David
strawberries when you watch?
JP Morgan had some matchman. Actually,
is that a thing?
I made some ice cream over the weekend and
you did?
had some strawberries.
No, not ice cream.
Just
gelato.
Gelato.
No, frozen yogurt actually.
With almond milk.
Wimbledon update for Bloomberg TV and Radio from Tennis Channel. I'm Johnny Ray Diaz. Alina Svitolina is back. The Ukrainian took out world number 1 Iga Swiatek in 3 sets to reach the semis at the All England Club for a second time. The victory was Svitolina's 4th win over a major champion in London in just her 2nd Grand Slam tournament since the birth of her daughter Sky last year. And don't forget, you can watch all the action daily at 5 p.m. Eastern on Tennis Channel. I'm Johnny Ray Diaz.
This is a year where the narrative changes every single week.
We need to be aware that every data release you get could be leading us astray.
I think you'd want to see lower inflation data, and I think there's a good chance you're going to get it.
Fundamentally, you've got a labour market that still looks too tight.
The market's starting to believe the Fed about a second hike.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television, CPI Wednesday, and the markets are on the move. John, since July 6th, 2 days after the celebration of the colonies, we have seen a disinflation in the two-year yield breaking down right now to 4.84%.
2 weeks away from a Fed decision, Fed hike in July, foregone conclusion. BMO's Ian Lingen, Deutsche Bank's Jim Reed, pretty much nailed on. How does this change the conversation beyond that July meeting, that data, Tom, 29 minutes away?
If we get the disinflationary tone that you're seeing, everything from Matt Bessler's work for Bloomberg this morning, James McIntosh over at the Wall Street Journal, if you get that disinflationary trend in place, something Goldman Sachs wrote up yesterday as well, it changes everything.
Base effects kick in. We're looking for a move from 4% to 3.1% year-over-year headline on Wall Street, Tom, as you know, focused on month-over-month. That estimate going into the print in our survey, 0.3%, 0.3% down from 0.4.
And Lisa, what's fascinating to me, and this is the Wall Street Journal article this morning, is they really pick on real estate as being bad math within the American inflation statistic as well. They're not having this conversation in Europe.
In Europe, they use a different measurement that, if used in the U.S., would make inflation substantially lower.
Yeah.
I put that out on Twitter, on other media as well.
Did Mary Daly retweet you?
Threads, which I have not avoided as of yet. And the responses are interesting. If you measure it another way, it's much higher. This is a question of measurement, and it speaks to the ambiguity of the moment where we don't know where it's going either way. My question is, does this inflation justify a surge in meme stocks, a surge in riskier assets, and suddenly a reversion to a frothier environment?
To get to the data, John, we're seeing that now in foreign exchange, weaker dollar. We're seeing it critically in the bond market. I've got West Texas Brent crude rounded up to $80 a barrel. But John, look at equities like yesterday. They're just trying to go higher. Can't get there. The VIX, 14.64.
Two-day winning streak could become 3 on the S&P with positive 0.3%. Tom mentioned that dollar weakness. 5 days of it now. 5 days of dollar weakness. If you're looking at DXY, the dollar index with that heavy weighting into the euro reclaiming 110 against the dollar, Tom, in the last few days.
Let's get right to it. This is an important conversation. We really want to take as much time as we can this morning with David Kelly, Chief Global Strategist at J.P. Morgan Asset Management. And what Dr. Kelly has done, folks, is say there is a point where non-farm payrolls will crack. David Kelly, fold in your guesstimates of the inflation view of America with your stunning call that we will see non-farm payrolls plunge here, that the labor market will crack.
Well, the labor market will eventually crack. I have to say that the momentum that we saw in the second quarter in GDP has put that out a little bit. I mean, I think it's more likely to be, very late in the year, early next year, when we see a decline in payrolls. But I think the much more important point is we're seeing disinflation everywhere. We're really seeing deceleration and disinflation in the U.S. economy. The numbers of today, I think, will get about 0.2% on the overall CPI, about a 3.2% year over year, looking at this on a seasonally adjusted basis, which I think is the right way to look at this. But the key thing is thereafter. I know the base effects go away, but I don't really see inflation picking up from 3%. I think it stays at about 3% on headline CPI through December, and then begins to fall all the way through 2024 down to 2% by the end of the year, as those shelter, that mismeasured housing issue begins to flip the other way. So overall, I see plenty of signs that inflation is just fading away here. And the frustration here is seeing the Federal Reserve still tighten to fight a battle they've already won.
How rapidly will they turn? I mean, I've been very, I think, fair to them, David. It's an institutional effort. They're allowed to be late. But when they, quote unquote, turn on a dime, how rapidly does that affect our world?
Well, I think the really interesting part here is at some stage we will get that negative payroll read. At some stage there'll be a real fear of actual recession here. At that point, the Federal Reserve stops its quantitative tightening and cuts rates. But the problem is the first rate cut they do is going to make the situation worse. Monetary policy is at its most restrictive and oppressive when rates are high and you start to cut them, because then everybody's waiting for the low rate. I mean, nobody's going to take out a mortgage when the Fed cuts 25 basis points because you know those rates are going lower and people are going to be scared that the Fed is scared that we're headed for a recession. So what I think the Federal Reserve is miscalculating here is the idea that they're going to be able to gradually bring down rates from a too high level in 24 and 25. I think that when they start cutting, they're going to have to cut pretty aggressively here.
So do you think that it's time to get more cautious at a time when everybody else is feeling pretty sanguine about the economy and the likelihood of a soft landing?
Well, we're not going to have a soft landing forever. I mean, there is no instance in the last 70 years of having the unemployment rate below 4% and then just move forward for like 3 or 4 years without a recession. If you're at full employment with a slow-growing labor force, it's kind of like riding a bicycle really slowly. Any wind can knock you over. And so I think at the moment the odds are we won't have an official recession start in this year. But I think as you go into 2024, the odds of recession increase. I don't think it's a big recession. I don't think it's really necessarily bad for markets. I don't even know if you get a huge market correction out of this, but I think it will take the last sort of whiff of inflation out of the economy. I think it'll change the Federal Reserve's mind.
So until then, do you just buy meme stocks?
No, you don't, because we'll have at some stage we'll have volatility, and I don't know that I'm not saying that a recession will necessarily cause, or a mild recession will cause a big market correction, but we'll have some market correction at some stage for some reason. And the thing is that the stuff that is not actually worth anything, that zooms on low interest rates or a frothy market, that's the stuff that's most vulnerable when everybody gets scared. At some stage, everyone will get scared. And the stuff with real valuation will do okay, and stuff that's just nonsense will take it in the chin. And that's why I would not overload on meme stocks or Bitcoin or any of this stuff.
So where would you position at this time when people are saying cash is still a good alternative, and then others saying if you do that, you're going to miss the opportunity in longer term debt and certain other securities?
Well, first of all, on that point, that's exactly right. I mean, we're close to peak CD rates, but when we look back at the last 6 cycles of the Fed tightening, at close to peak CD rates, CDs are almost never the best investment. And we're at a 4% 10-year Treasury. A real fear of recession could easily bring that below 3%. So right off the bat, that's a 12% annualized return of a 10-year Treasury bond. That's better than a CD. And remember, you get these CDs now, but what are you going to do when you have to reinvest in a year's time or in 2 years' time? Yeah. So I think there is an I would be long duration bonds. I'd still say high quality because of the risk of some economic turmoil here, but I'd stay long duration because there is a play there. And then for equities overall, value does look very cheap relative to growth right now. And notwithstanding the fact that growth seems to like lower rates, I think that the valuation gap is so dramatic there that I would be a little overweight value, a little overweight international too. I'm really impressed by the fact that the dollar is coming down on a 4% 10-year Treasury yield. And that tells me that when rates go lower in the U.S., we could have a significant dollar decline. I think a big positive for international.
8 ways to go here, David Kelly, but let's just keep it simple. You're looking for a demonstrative weak dollar move?
Yes, I mean, over the next few years, that's very likely to happen. The problem has been the first half of this year, we thought the US was going to slow more quickly. We thought Europe would be a little bit more resilient. That hasn't played out that way. But I still think that where we are is the Federal Reserve is just overdoing it. And they've got this weird notion that they can overshoot in rates and then cut rates dramatically. That's not the Europeans' playbook. It's not the British playbook. Certainly not the Japanese playbook. So that gap in rates is going to close over the next few years as the Federal Reserve brings rates down and the ECB, the Bank of England, and the Bank of Japan don't. That should push the dollar down. So I think in the next few years, you will see a significant dollar decline.
David, John's been so good about outlining the shock in the United Kingdom of inflation, particularly in utility bills and real estate as well. Are you and your shop optimists on United Kingdom disinflation?
I think ultimately, yes, but the problem is that comes from a fair amount of fear about just the overall position of the UK economy. I think one of the big issues I think is the UK's got a pretty bad fiscal situation, and the question is, does the government actually tackle that with the risk of slowing the economy, or do they let it get worse? If they tackle it, I think you will get less inflation in Britain, but it could be a pretty a pretty miserable time. So we're not, I would say disinflation will take hold in Britain eventually also. It's going to be a slower process in the US because they've got a very strong union movement in Britain, and they're all on strike. You know, there are far more strikes there than in the United States. But I think disinflation will take hold in Britain as the economy slows. But it's not a particularly good outlook, you know, getting there.
Only an Irishman could say that, TK. You know, the Brits, they're just all on strike.
He's on a central casting. You know, he does.
Isn't it just perfect, isn't it?
It's just perfect.
David, how bad would the inflation problem be if we had union membership in line with, say, the 1970s here stateside? How bad would the inflation problem have been in the last 12 months?
It'd be significantly different, because what we've seen is wage growth has been decelerating here since March of 2022. I can't imagine that if we had, you know, 25-30% of the private sector unionized, as we did back in the 1970s, that we'd have had anything like that deceleration in wages. So unions would be out on strike saying, give us 5%, give us 10%, give us 15% raises. So we'd have had chaos, but we'd also have had much higher wage inflation, and that would keep inflation stickier. But, you know, back in the 1970s, we were having over 200 strikes per year. We had 23 strikes last year. We've had about 6 major strikes. Major strikes. We've had about 6 major strikes this year. So it's nothing like the 1970s. And this is why it's so bad for the Federal Reserve to say, oh, let's talk about the lessons of history. The only lesson of history on high inflation in the United States is from the 1970s. And that is a very old playbook, and it's really a different labour market from the one that we had back then.
David, thank you, sir. Really? David Kelly there of JP Morgan Asset Management. Going into inflation, Tom. 18 minutes away.
His call on the job market, linking it into inflation, is extraordinary. He's one of the very, very first people I said that, look, we are going to collapse. We're going to have this gift of 200,000 plus per month non-farm payrolls. It's going to evaporate at some point.
We'll see what we get.
Very lonely
in just a moment. CPI just around the corner. If you are just tuning into the programme, welcome. The S&P 500 positive by 0.25%. Coming up, former New York Fed President Bill Dudley ahead of the US CPI data. Yeah. Looking forward to that. Tom, I know you've been itching to talk about this all morning. Not Bill Dudley, not CPI. Mr. Ricardo.
Surveillance is
Mr. Ricardo has got a seat. Alpha Tauri.
What we've learned with our 5 audiences, it's very, I don't want to go into the details now, is a lot of people watch us to get a new job. And so Ricardo was on, and, you know, David was on, and Daniel was on, nailed that. You know, he's
Dave,
from Western.
He's
from Western Australia. But anyways, Ricardo's on and he's lighting it up. Boom, he's got a new job. John, explain how Red Bull has 2 teams. They fired one kid that wasn't doing it.
Nick DeVries.
And so Ricardo is the backup driver's going to go over to the other team, right?
So Alpha Tauri is kind of like bottom of the pack right now, which is, let's call it the sister team owned by Red Bull. Red Bull,
the
of course,
Austrians.
Top of the pack. Yeah. He actually came out of Toro Rosso, which is the old Alpha Tauri.
This is where Ricardo came out.
That's where he came out and ultimately got picked up by the main team, by Red Bull. So, look, we wish him luck. It's going to be difficult. It's a hard car. So right now it's slow compared to the rest of the grid, so it'd be difficult to get on, say, like the top 3.
They have a yellow flag.
Onto the podium.
And they got
let's
a
hope
pit.
He gets some decent races.
And he's going against Perez.
Talk over me.
No, but John, so he's going against Perez.
Okay,
what happens?
No. If he has a good season, and you're going to have to define what success would look like at AlphaTauri, but if he manages to impress, then you'd wonder if Checo's seat at Red Bull was under threat. Given the difference between Max and Sergio Perez right now.
Max is Max.
Well, Max is phenomenal, but he seems to be so much better in that car.
Who do we have to have on next to get him a job?
Than Checo. You know? Who would you like to catch up with?
I don't know.
Sport?
You know, Piastri did well.
We can talk to some free agents in the football world, Tom. It is summer.
Yeah.
We can have a conversation with them.
What's Loris doing, the goalie for Tots?
Talk that he might leave.
Yeah.
This is great stuff.
It's great stuff.
Thanks.
Inflation remains well above our longer-run goal of 2%.
We're likely to need a couple more rate hikes over the course of this year to really bring inflation back.
It can take some time and assess and collect more information and then be able to act.
I do believe that underlying inflation is declining gradually and in a way that may well be sustainable.
We'd say we're close, but we still have a bit of work to do.
That was Fed Chair Jerome Powell, Fed Speakers Mary Daly, John Williams, Raphael Bostic, Michael Barr, all with their own opinion. In 2 weeks from now, they'll be around a table and they've got to make a decision. Do we or shouldn't we raise interest rates?
The IMF just did a massive study on economists' predictions. I think Paul Krugman highlighted this. I'm not quite sure on that. But the answer is really in recent days, they don't have a clue. I mean, we're doing this, folks, and you saw it beautifully there in the Sodden with our very important guests coming up here. And the answer, John, is this is such a tough game.
You never know with certainty. You're in the risk management business, Tom. So 12 months ago, balance of risk.
Well said.
Balance of risk. The risk of doing too little outweighs the risk of doing too much. 12 months later, the balance of risk clearly shifts, which is why you're starting to see some splintering on the committee. That's just stating the obvious. So some people, Tom, are pushing for another 25, maybe 50 on the committee. The chairman, when he speaks, he's got to do the best he can to kind of represent some form of consensus on the FOMC right now at the moment, and we can gauge that from the dots. But if you look at the median dot, sure, that tells you one thing. You look at the spread at the moment, Tom, going into next year.
Yeah.
There's a range of views on the committee
on
on where we should go.
The hallmark of Bloomberg surveillance, folks, is we want to talk to people informed that can really state what they believe in and the risks that they see. We've extended that to someone, and we're going to be with you commercial free here throughout all of the inflation and on into the later part of the hour. William Dudley joins us. It's been a wonderful relationship since his days with Goldman Sachs. He's a former president of the New York Fed and, of course, a Bloomberg opinion columnist as well. Bill, to John's good comment there on everybody's in risk management, what are the asymmetric risks or the asymmetric balance that the Fed has right now as a new group of people tout a rapid disinflation?
I think the Fed's concern is that if they ease too quickly, financial conditions will ease as well, the economy will come bouncing back, and inflation will not stay down for an extended period of time. We tried to explain that a lot of the inflation was transitory on the way up to explain it away. Well, some of the disinflation that we're seeing is transitory on the way down, the goods price disinflation. I think the Fed still thinks that they haven't done quite enough because the labor market is still very, very tight. And wages are still at a level well above the 3 to 3.5% range that Chair Powell said is consistent with 2% inflation. So, yes, the CPI report is important today, but probably even more important is what's happening to growth, what's happening to pressure on labor resources, and what does that mean for wages.
How important is the real estate analysis? In the zeitgeist this morning, James McIntosh at the Journal, Matthew Bessler at Bloomberg News talk about the mystery of how we measure real estate inflation. Do we have an accurate reading?
Well, we measure it in a funny way in the United States where we basically say, if you had rented your home to yourself, how much more would you have to pay this month? And that gets fed into the consumer price index, even though people obviously don't pay themselves for the home that they own. So it's a bit of a fantasy. And obviously that number is going to be coming down in the second half of the year, owner's equivalent rent, and that's going to flatter the headline inflation numbers. What Chair Powell and others have made clear, though, is what's happening to services ex housing is going to be very, very important, because that's the part of the inflation picture that's driven by wages, and wages are driven by how tight the labor market is. So until we actually see significant improvement in how services ex housing, I don't think the Fed is going to be completely comfortable. The CPI report today will be probably a pretty good reading. The problem is that the Fed pays much more attention to core personal consumption expenditures, and that core reading has been stuck in a range between 4.6 and 4.8% for the last 6 months. It actually isn't showing meaningful improvement.
How concerning was it to you that earlier this week the New York Fed put out the U.S. consumer inflation expectation survey, and it showed, on the good side, at least for the Fed, a decline in near-term inflation expectations, but an increase in longer-term inflation expectations that was much greater than people had previously expected? Is this an alarm bell to you at a time when the Fed wants to avoid inflation expectations from becoming unmoored?
I would say 1 month reading, it doesn't make me alarmed, but the Fed is nervous that if it takes too long to bring inflation back down to 2%, people may start to think that the Fed's never going to get there. And if they think that, then inflation expectations will drift up, and they'll make the Fed's job more difficult. That's why I think they want to stay the course now, get inflation down to 2% by roughly the end of next year. And if they do that, they're pretty confident that inflation expectations will stay well anchored, and that'll make their job much easier going forward.
One concern has been that longer-term yields are not cooperating, that they've been declining, and that they haven't gone up as much as people perhaps would like to be more restrictive. We're looking at a 10-year yield of 3.9%. You see that going to 4.5% as a conservative guess. What would the Fed have to do to get it there?
Well, I think it's mostly about the market psychology about where we're going in the future. In other words, what's the level of normal short-term interest rates? What's the level of the bond risk premium, the spread above bonds relative to the path of short-term rates? People, I think, are very much putting a lot of weight on where we were post the great financial crisis. And I think we're actually going to a very different place where inflation is going to be a little bit higher, probably average around 2.5%. Short-term rates that are consistent with a neutral monetary policy in real terms are probably going to be a little bit higher than they were in the past because the fiscal situation in the U.S. is a lot worse than it was 10 years ago. And the fact that, we have a lot of investment demand now that we didn't have before for climate change. The tremendous amount of money is being spent to facilitate the transition, the climate to transition, and that's also going to put upward pressure on rates. So I think I think the bond market is still overly optimistic about where we're going because I think it's putting too much weight on what happened post the great financial crisis.
Bill Dudley, I want to go mathy on you here, and it's with a Bank of America chart, which shows a wonderful fan distribution of potential outcomes of where we are on inflation, of getting from 4% in some of the fan is to a lower statistic, some is to some form of stasis, and dare I say there's a camp that says we may see a turnaround and a higher inflation. If you set up the present vector, the direction of disinflation, how skewed are we right now to a higher inflation or a lesser inflation, a greater disinflation?
Well, I think there's two positives and one negative. The positive is that goods prices are coming down, partly because people have changed their demand composition. During the pandemic, they bought a lot of goods and not so much services. Now they're buying services, not so much goods. And so you see a lot of weakness in goods prices. Number two, you're seeing the fact that the housing price inflation is going to start to come down with a lagged effect, but we're not seeing any progress on the services side outside of housing. And we're not seeing any progress on the labor market. So I think it's still a mixed picture. The good news is the Federal Reserve has gotten now to a restrictive monetary policy. I don't think it's that restrictive, but it's restrictive enough that it should slow the economy down. And probably the Fed has another 25 or 50 basis points of rate hikes to go. And if they do that and they hold that for a while, that should be sufficient to do the job on inflation.
What are you looking at when you talk about longer term? We're not going to be going back to the low inflation regime that we were in previously. And I see this at a time where increasing automation is driving efficiency and perhaps productivity in a number of different companies. For example, Chipotle with avocados and new avocado cutter and peeler as they try to reduce the amount of time. And how does this factor into the longer term paradigm?
Well, the interesting thing is the actual productivity numbers over the last year or two have been horrible. So we're actually not seeing the productivity improvement yet generated from things like artificial intelligence. And it could actually take quite a bit of time. There's a whole bunch of things that we do in the economy that aren't getting more efficient. You think about, hospital care, medical care. You think about home construction. Think about, our teachers becoming more productive in terms of how they're teaching their students. So there's a whole part of the economy where productivity gains are very hard to come by.
John, how do we get to avocados and avocado peelers there?
Bramo's reading.
It relates. It's actually relevant because
Dr. Dudley knew exactly what you were talking about.
Yes, because a lot of fast food companies have been automating more, and Chipotle now has a collaborative robot dubbed Autocado that cores, cuts, and peels avocados before they're mashed.
I'd love one of those.
Amazon Prime, I could see it in the Bramo kitchen.
A lot of
Did you do Prime yesterday?
No, I did not. I'm the only one in the country who has
Did you do Prime yesterday?
Dudley does Prime.
Okay.
Did you?
Yeah, I got some protein.
Protein?
Yeah.
With your almond milk?
Yeah. Good. Yeah, ready mixed. The ones I have in the morning. You know the ones, breakfast.
I do know what you're talking about.
Stocked up on breakfast. Bill's going to stick with us. And it's CPI. Maybe. Mike McKee. Look, if you're on TV, you can see it. If you're watching this on radio, you can't. So allow me to describe it. Mike McKee in this romantic log-fired cabin scene, Tom,
20
in
miles
Idaho
from
at the Rocky Mountain Summit. I mean, what are we all doing wrong?
He owns the high ground. That's all I can say.
Just beautiful. Mike, you're going to join us, and thank you for taking some time to actually come on with us today. We appreciate it. We really do. CPI out in about 4 minutes, Mike. What are you looking for?
Well, we're looking for a very good report this time, especially for headline numbers. But as Bill made the really good point that things are going to be transitory on the way down. We're not going to hold the same numbers. We also run into what's called base effects in economics. Because inflation rose so much in June last year because of energy, then it's going to look much better this year. And we're going to see probably a big drop in the headline number. But the Fed will be looking past that because they know it's going to be tougher the rest of the year. Inflation had come down on a month-over-month basis significantly after June. So don't put all your money on this being the turning point yet.
Mike, we were told that we had two important data points going into the July Fed meeting. That's 2 weeks away. We had payrolls last week. We've got CPI this morning. They're the two. Deutsche Bank and Jim Reed earlier today. Hike in July is pretty much nailed on. BMO's Ian Lingen said this yesterday. Quarter-point hike on July 26 is a foregone conclusion at this point. Mike, is there any reason to believe that the information we see in a couple of minutes' time could change that conversation?
I don't think so, for the reasons that I just mentioned. The Fed is going to be looking past a lot of those different one-off kind of changes. They're going to want to see consistent movement. And as Bill Dudley said, they're going to want to see services ex-shelter start to drop and start to drop significantly. We have not seen a real change in core or services X since the beginning of the year, and that's what the Fed is looking for. So we'll get that rate increase in July. The real question is the data between now and September. Does that make a difference to them in terms of that second move?
Mike McKee, stand by in just a moment. About 2 minutes from now, we get some CPI data for you. On to PPI tomorrow morning. Mike McKee's going to break that economic data for you. And then Bill Dudley, former New York Fed president, now Bloomberg opinion columnist, amongst other things, is going to weigh in and respond to that. The scores going into all of this, equity's actually a little firmer, positive on the S&P 500, up by 0.2%. Yields going into this, Lisa, just backing away ever since that ADP report on Thursday. You had the information on Friday we learned from payroll. Since then, yields lower.
People don't seem to think that disinflation is transitory, to use some of the language that we've been hearing. They're banking on it. And that's what we see in the bond world, and that's what we see in the equity world as well, John.
Can this service pressure in things like airlines, and we've seen where the cruise operators and what they're doing year to date on the S&P 500, can that continue? Do we have those pockets of cash, those piles of cash that we did coming out of the pandemic still?
There are reports that it's running out. We've seen those reports. It was expected to run out of the first half of this year. What people haven't grasped is how much that ball of money that was put into the economy keeps rolling from sector to sector as people spend, and it goes to other people, and it boosts.
What'd you call it, a ball of money?
Yes.
The ball of money just rolled over and went to camp. That's where it did for.
Oh, that's why your ball of money.
The ball of money just went over to pay for camp for various and sundry offspring of the Abramowicz and Keene
Lisa's
plan.
been on top of this on a serious note. When those tuition repayments start to resume again, those student loan repayments start to,
I made a joke about it.
There's a worry that starts to bite.
Yep.
I made a joke. Somebody cut me off and said it's serious.
It is. It is potentially, anyway. Yields right now a little bit lower. We're down 4 basis points on a 2-year with that economic data. CPI just dropping across the Bloomberg terminal. Any second now. Let's get out to Mike McKee. Hey, Mike.
Well, John, we're waiting for the numbers to come down, and we are expecting a change in the overall headline number that will look good. And here's a number that comes in even better than expected, and that's the CPI core on a month-over-month basis, just up by 0.2. The expectation was for 3. It was 4 last month, and that puts CPI core below the anticipated number at 4.8%. The forecast was for 5%. On a headline basis, we get a 0.2 move, also lower than anticipated, and that brings it down to a 3%. A year-over-year number. And, of course, these numbers are going to be the lowest since the pandemic and the lowest we've seen in about 2.5 or 3 years. So good news overall. But, again, we want to warn everybody this is essentially a transitory kind of situation. Let me get you a couple numbers here quickly. Food. Up only 0.1. Remember, that was a big contributor a year or so ago. And energy prices up 0.6. Gasoline up 1%. So all of these numbers are in spite of a rise in energy prices. Gasoline had fallen 5.6% last month. And then in terms of used cars and trucks, this is something everybody's been waiting for. Used cars and trucks down 0.5 on the month, and on a year-over-year basis, down 5.2%. So a quick turnaround in used car prices. Apparel prices up 0.2, and shelter prices dropped back a little bit, 0.4. I'll get you the number on rent of shelter, the one that is that matters to everybody, and we'll get the numbers on X services in just a second.
Mike, thank you, buddy. You get into that. You dig into it. We'll dig into the price action. Let's push through that downside surprise into equity markets right now. Futures positive by 0.7% on the S&P 500. Guess what bond yields are doing? They're diving. On a 2-year, we're down by more than 10 basis points. 477 on a 2-year right now. Think about where we were on Thursday, 511 after ADP. We have backed away and backed away some more. So yields down, dollar weaker, 5th straight session. This time, the euro breaking 110.50, 110.67, a session high now. Bear in mind that close to 111, I think 110.95 earlier this year was the high of the year. That was in late April, Tom. That was the high of the year on euro of 110.95, just short of it following this data.
You get printed moments of $80, a true $80 print on Brent crude as well, showing maybe a more buoyant global economy off of disinflation salvation in America. John, you have a jump condition in the 10-year real yield, and to go from the 1.80 number of the panic of, I think it was July 6th, down to where we are right now, 1.66 is nothing short of a miracle.
If you are just tuning in, this is a downside surprise across the board here, month on month, closely followed by people on Wall Street. 0.2% for core, stripping out food, stripping out energy. 0.2% for headline month over month as well. That's down from 0.4% month over month previously in core, and down from 0.1%, just a little bit firmer there on headline. Headline looks like this. Year over year, 3%, just 3.0%, down from 4.0% previously. Strip out food and energy, 4.8%. That is down from 5.3%. The idea that we get a hike in July, most people still assume that's going to happen. The idea we get one after that, Bramo, I think a big question mark after that information this morning.
And if you look at what futures traders are pricing in, it's a lesser chance of a second rate hike. I want to point out that real average hourly earnings rose at the fastest pace going back to March 2021 because of the decline in inflation. This according to the latest reading and the data. So this is the other side of things, how this supports spending. On the flip side, even as inflation comes in.
Neil Dutta, Renmac. It's Dutta's big argument, isn't it? No doubt we'll catch up with him soon. We'll catch up with these guys in about 30 minutes' time. Robert Tipper-Pejim, Krishna Mamani of Lafayette College, Sarah Hunt of Alpine Saxon Woods responding to this inflation report, Tom. Softer, a welcome downside surprise. Equities higher.
John, Swiss franc stronger. We usually look at Euro Swissy. That's what you and I look at. But to see dollar Swissy go out to strong Swiss franc here, it's got shades of 2011 in it. We're not there yet, but it really shows how this U.S. inflation report has a global ramification.
Doesn't change July in the minds of many. Let's wait for the Fed speak. Lisa said there's plenty through the whole of today. Tom, so look out for that. We'll see what they say, see what they guide us towards in 2 weeks' time. But ultimately, it could change the conversation in September if you get another one like this next month going into that September meeting. And to Jackson Hole, too.
Yeah, well, Jackson Hole may change as well. Let's go 20 miles north to Victor, Idaho. Michael McKee is there in a pre-Jackson Hole. Michael McKee, your thoughts as you dive into the economic data?
Well, this is a bit better than anticipated, but it basically tells the same story that we thought about going into this meeting. We did see the first significant declines, I suppose you would call it, in shelter costs that have been propping up a lot of the inflation that we've had. Rent of primary residence is up by 0.5%, no change there, but the owner's equivalent of rent drops to an increase of just 0.4, which is the lowest in quite some time. We're starting to see that get into the numbers, which is what you want to see. Airfares went down 8.1%. I'm not sure a lot of people are going to believe that. John, you've been flying around, but we did see a a decline in airfares. And as I pointed out, we saw an increase in energy. But a lot of this is all going to be offset by the fact that the base effects from this year, this is going to be one of the best months that we see. And I'm still waiting here for the Services X to come in. And it now comes in on a month-over-month basis, 1.3%, which is a significant improvement from the over 6% we started with at the middle of last fall. On a year-over-year basis, we're now down at 3.93%. So we're seeing progress in Services X shelter. That'll cheer the Fed, but it won't change their minds.
Moments ago, Brent crude ticking over $80 a barrel. And John Ferro, that clearly has something to do with the expense of your travel on your sabbatical.
Just on the record, moments ago, I was just stepping away.
Yeah.
I'd unplugged the microphone. You take a dig at me as I'm walking out the door.
Correct.
I didn't take a dig at McKee did. McKee took the dig. That was a McKee effort.
No one believes the airline numbers, never mind the rental numbers.
I would agree with that. Anyone trying to is absolutely
Anyone believe the airline numbers?
No, that is a McKee production as well. We're going to try to continue, and this is market moving data. Mr. Farrell's going to get ready for a 9 o'clock effort. Equities lift, NASDAQ up a full 1%. That in itself is fascinating. And in the bond market, we have continued thrust, if you will, off of the news. A 2-year yield, 4.73%, a ginormous 14 basis point move. In the more elastic 2-year yield, the real yield is important to me, 1.67%. We get perspective from William Dudley. Bill Dudley, describe transitory on the way down. I don't understand that. How do we have transitory disinflation?
Well, remember, goods prices went up dramatically because during the pandemic, people bought a lot more goods and bought a lot less services as they stayed home. Now we're on the flip side of that. They're buying less goods, more services. So goods prices are very weak, and they're going to be very weak for a while as people manage their inventories down. But once that comes to an end, then goods prices will level off. And so the benefit to headline inflation from falling goods prices will be over, and you'll be stuck with what's happening in the services side. Look, I think this is a very good report today, and the Fed should be pretty cheered by this. But I don't think it changes what they're going to do at the July meeting, because I think that they said that they're looking at the totality of the data over the last 3 months going into the July meeting. And the reality is the economy is still doing quite well. We had 2% growth in the second quarter. If you look at the Fed GDP Now tracker for the third quarter, it's at 2.3%. So the economy really hasn't slowed down enough to make the Fed confident that they're going to see that slack in the labor market that they want. What I think this does do is opens up the question is, could July be the last one? And that's certainly possible, because they won't move at the meeting after July. They'll take a break just like they did this last time. And then we're going to get to November 1st. Well, there's a long time between now and November 1st. I can imagine by that point, it's possible that they'll see enough news that makes them confident that they've done enough. So I think the November rate hike is really up for grabs at this point.
Bill, you talked about how disinflation might be transitory and that there could be a reinflation once the base effects are stripped out, and especially as real incomes continue to rise at a faster pace as inflation comes in. What do you have to see to believe in the disinflation, that it will hold and revert back to a sub 2% inflation norm over the longer term?
For me, it's all about the labor market. I want to see a slowdown in payroll employment growth. I want to see a rise in the unemployment rate. And most especially, I want to see further moderation in wages. So the labor market's too tight, then you're not going to get inflation back down to 2%. That's the key.
Bill Dudley, thank you so much for joining us. Your commitment to Bloomberg surveillance, really, really appreciate it. William Dudley, writing for Bloomberg Opinion, and of course, a former president of the New York Fed. Thanks to Zero Hedge, they had out yesterday a Michael Gapin production. That is a chart from Bank of America that showed the fan distribution of our American inflation, where we could see the surprise of a normal disinflation back to the 2% level, or maybe something stasis 3-4%, or dare I say we could even see sticky inflation and a rise as disinflation moves lower. A lot of confusing trends in math. Michael Gapin joins us now, head of U.S. economics. Michael, what's the key determinant of how disinflation unfolds?
I think it's catching on with what Bill Dudley just said. Does the labor market soften enough to give you confidence that services inflation will keep inflation running around 2%? So for me, it's about broad-based disinflation across services. Yes, we should get some payback in goods prices. We saw that again this month with used cars. But can we get a combination of disinflation in services? So beyond shelter, I agree with you. I'm not sure airline fares fell 8% on the month, but is it broad-based enough to make you confident that the new trend, or we're back to our prior trend of roughly 2%?
What do you make of what Bill Dudley was just talking about, Michael, that you can't see this ongoing disinflation unless the labor market cracks, unless you see a bit more loosening in what we see in the job space? Do you agree with that? Do you think we need to see that pain in order to create a subsistence in this low inflation?
I do agree with it. Now, it doesn't necessarily mean the Fed keeps hiking. I agree with the narrative of, I think the Fed will hike in July. If we're posting 0.2s on core from here, it'll call into question what they have to do after that. So they may stay on hold. They may be reluctant to cut until they see more evidence that the labor market is imbalanced, that supply of labor and demand for labor are more imbalanced. So that argument may be more about how quickly the Fed cuts or when it cuts than it is how high the Fed goes in the near term.
This is an interesting distinction because Bill Dudley has been pretty hawkish in terms of the Fed having to do more in order to get inflation under control. And yet he just came out and said this is a great report and this may be the last rate hike that we see from the Fed this month. They may not go in September. That brings us to November, a lot of data in between. Is that bullish or bearish for bonds? Is that bullish or bearish for the idea of how long the Fed can hold rates at a high level?
I think on balance, you'd have to conclude that it's bullish in the sense that we're seeing disinflation in the U.S. economy that is gradually becoming more broad-based in an environment where the labor market still is very healthy and the unemployment rate is low. So again, I think what Bill was saying was if this is the new run rate, then yes, it would call into question hikes beyond July, and it might give you more confidence that, say, less pain in the labor market is needed to convince and give the Fed confidence that inflation stability, price stability will be restored. So on net, I think it's hard to argue that disinflation in an environment of a strong labor market is bearish. I think at the moment that's a bullish view.
Where are you on nominal GDP? I mean, Michael Gapin just simply here, if we go out 1 year, dare I say out 2 years, not that anybody's modeling out to 2025, but do we get back to some kind of 4% top-line GDP, 2% inflation, 2% real GDP?
Probably not until 2025. If most of our baseline forecasts are accurate for, let's call it, gradual disinflation and perhaps a hiccup in growth here. In the short run, if growth continues to slow down, you might get something around 4% temporarily. But I think nominal GDP growth is likely to remain pretty healthy until you get into 2025 and inflation maybe is settled down to around 2%.
If you're joining us right now on radio and on television and nationally, we are commercial-free through the rest of this hour. Lisa Abramowicz and Tom Keene, John Ferro as well here with a shock inflation report. And Lisa, as I sum it up with futures up 30, that's SP futures, Dow futures up 172 after a buoyant Tuesday. NASDAQ futures are giving me up 1% moments ago. And there's a little bit of an ebbing and flowing here, but certainly the shock is a celebration of disinflation.
Yeah, in the currency space in particular, you're seeing the Swiss franc right now at the strongest versus the dollar. Going back to 2015, you can see pretty significant and strong moves across the board in the two-year space, yields coming in dramatically as people start to game out what it looks like if the Fed rate hike this month is the last in the cycle. We're speaking with Michael Gapin of Bank of America. And Michael, you were saying that if this data does continue, that does seem like a likely case. I just want to get a sense from you on the real wages point. How much does that make it difficult to see ongoing disinflation, that real wages are rising at an accelerating pace?
I think it makes it difficult if you're a policymaker and you're thinking, I need to get demand and supply into better balance, but what I'm seeing is a consumer that continues to want to spend and is getting significant increases in real wages. So it may be hard for them to, again, make that conclusion that we're on a path back to 2. It's about confidence in that outlook. So you need a combination then of actual evidence on the ground that, where is the new trend in inflation? For example, is it 0.2 or is this a one-off and we go back to a 0.3? And 0.3s are more the run rate. Or, you need a collection of evidence on what the new run rate is, plus where spending and real wage data evolve. Again, this may ultimately be about the timing of cuts and how quickly those cuts come in. And the near-term path for the Fed may be more about these prints on inflation. Inflation may dominate whether the Fed hikes beyond July, but the cutting environment, when they're back to a neutral rate of interest on the other side, could very much be about that labor market story.
Meanwhile, counter-programming is Richmond Fed President Tom Barkin, who's speaking at a separate event that came out in tandem with the CPI data, saying that the U.S. inflation rate is still too high, that the Fed has been moving aggressively as it could against inflation, and talking about the longer-term view. Michael, if we do see the rate hike that we get this month as the last in the rate hiking cycle, how long do you expect rates in the U.S. to remain about 5.3%, give or take, for the foreseeable future?
Well, we have the first cut coming in May of next year. So our baseline still has another hike beyond July, but we've highlighted that ultimately will be data dependent, and we'll have to see how things evolve. Our first cut and an end to balance sheet runoff would be in May of next year. So the debate on the committee is some combination of higher or for longer. And I think they would be inclined to want, again, this is about the evidence, the accumulation of evidence and confidence about restoring price stability. So we don't have that first cut until May of next year.
Michael Gapin, thank you so much. And congratulations on that really informative Bank of America chart of the last 24 hours. This is for McKee, and I think this is David Rosenberg will be with me on radio, I believe, here in the next hour with Paul Sweeney. But Lisa Abramowicz, I think this is really such a big deal, how McKee breaks it down. And, of course, he's having a manly breakfast in Victor, Idaho at the Rocky Mountain, whatever it is. Disinflation, bacon, down 1.7%. Disinflation, eggs, you know how expensive they got, 7.3%, down 7.3%. He notes that the beverage of your choice, flat.
After pretty substantial rises during the pandemic.
Yes,
that was,
we do.
Yes, okay, thank
but
you
that's
for letting
the
us know that.
granularity.
Is that your breakfast?
That's my breakfast.
Bacon, eggs, and a glass of whiskey.
We call that a shot in this. It's not a glass.
Okay, thanks.
Let's be sure we're looking at that. Saving us here. And folks, we welcome all of you on radio and television to a major market move off American disinflation. Megan Horniman joins us now, Chief Investment Officer of Verdance Capital. Megan, do you change your outlook with this disinflation report?
No, I think this was a good report. I do agree with that. Inflation's going in the right direction. Disinflation is starting to take hold, but I don't think it changes the move in July from the Fed. They can't take their foot off the pedal yet. There's still three things that they're looking at, and they're not necessarily looking at airline fares. What they're looking at is housing, which owner's equivalent rent is still slightly elevated. They're looking at earnings, which we've just finished talking about how real earnings now are higher. And they're also going to be looking at the service sector. So those three things, they are improving. You can't deny that in the report today, but I just don't think it's enough for the Fed to say we're completely done.
Do you think, though, that there is a greater likelihood as a result of this report that this rate hike at this month's meeting will be the last?
If this is the trend that continues, yes. Let's keep in mind there's a lot of base effects in this report, so we don't want to take 1 month as a trend. But if this continues, yeah, I think this may be the last. But I don't think they're going to be cutting, and that's something that we've been saying for a long time. The market is too optimistic about the path and the timing of rate cuts. We think they're going to stay higher for longer. They've told us that, and they can't afford, especially with the consumer still wanting to spend, to take their foot off the gas here.
That said, how does this shift your view on how to allocate your assets at a time when a lot of people are betting that the economy can remain strong, even as we continue to see price stability restored to the market?
So we've been taking the opportunity this year with the big rally we've seen across the global equity sector to start to reduce some of the allocation. We want to get more to a neutral weighting to our benchmark because while we're looking at a period where the Fed may be near the end of their aggressive tightening cycle, we're not calling for cuts. There is still, as we said, there is still some inflation in the pipeline that they have to get under control. Our bigger concern is that the market's gotten a little too optimistic about the economy. We continue continue to see in a lot of these reports underneath of the details that there is significant weakness in the economy and especially the consumer. We've talked about this before, the Fed tightening cycle as well as now tightening lending conditions. This takes time to work into the economy. We haven't seen those full effects. The labor market's now starting to show signs of weakness. This is all negative for the consumer. So we're concerned about the consumer in the second half of this year, despite some of this positive inflation report, because we just don't see the spending that we saw in the first part of this year sustainable.
So to cut to the chase, Megan, I think this is really important. A tepid economy just simply means less revenue for corporations, and that's where the earnings shortfall begins.
Mm-hmm. Right. And this is, we're getting ready to start this earnings season here in the second quarter. This is the first, the worst, it's expected to be the worst earnings season that we've seen since the pandemic. We don't really think that this is completely over from an earnings perspective.
I look, Megan, at the step forward here. And I get that this is one report. Lisa's told me that 3 times today. Maybe you take a smooth 3-month moving average of disinflation. Did the disinflation vector change enough for you to have to sit down and recalibrate getting to the third quarter?
No, not yet. I still think, like I mentioned, those 3 things, that's what the Fed's looking at, and they have gotten slightly better. But even if you look at the owner's equivalent rent component that was running a 0.5 on a month-over-month basis, it slipped to 0.4. Is that enough for the Fed? I don't think so. I still think that's a concern for the Fed. So I'm not ready to make any changes. We're sitting neutral with our equity exposure. We have a nice cash position because we are earning now on that, and we're looking for the potential that we could see some weakness in the equities in the second half of this year.
I got to say, Tom, I'm looking at Bespoke Investment. They put out a report saying that at the headline level, there have only been 2 stronger than expected CPI readings in the last year, which is the fewest in a 12-month period going back to November 2019. On a core basis, just 3 stronger than expected monthly CPI readings. That has been the fewest since November 2020. There is a sense that Wall Street doesn't have as much faith in the disinflation as is actually coming through in the numbers.
This is really well timed that you bring this up because Dr. Dudley alluded to that when he did his Newtonian calculus in English, where we talk about the first derivative, the second derivative. You'd make jokes, particularly if you had a hangover from course 3-2 light, you'd make a joke about the third derivative or the fourth derivative. But all of this anecdotal evidence leads to some form of vectors which say the agony of this inflation is over. Then the debate begins.
From an investment perspective, Megan, is it time to get out of cash, maybe not go into riskier assets, but lock in yields at a higher level
what David Kelly
if
said.
we are seeing inflation come in?
Yes, and we actually started to do that recently as well. We moved our duration of our fixed income investments out a little bit, not significantly long at this point, because I still do think there is that uncertainty around the Fed. Yes, it looks like they may be able to be done in in July, but when it comes to rate cuts, when are they really coming in? And we don't think that's the story until 2024. So it's not a rush to run into the long-term yields at this point, but we do think you should move out some of those shorter durations into more of an intermediate duration.
Megan, thank you so much. Megan Hardiman with Verdant's Capital Advisors today. I'm going to call it a sustained reaction here. Yeah, there's a little bit of a pullback, and we'll show the charts on TV and discuss them on radio. But the bottom line is clearly off of the enthusiasms of Tuesday afternoon into a Wednesday where I would suggest the disinflationary zeitgeist got it right, Lisa.
Absolutely.
You've got a tangible move here. I'm looking at the levels. I got 4,500 on SPX futures, 34.6 on the Dow. That's 34,600, Lisa, on the Dow. And the NASDAQ 100 to be rebalanced here, up 0.9%. Rounded up 15,400 on the NASDAQ. I'm in triple leveraged all cash. Maybe an odd lot of Apple.
Markets are partying right now. They're excited about disinflation, and the data certainly suggests any way you slice it, it is inflation going lower. Jason Furman putting out, formerly of Harvard, I should say, that even the supercore data that the Fed looks at, which excludes food, energy, shelter, and used cars, also coming in dramatically. Any way you slice it, it says the same picture, the same story, Tom, which is it is a lesser inflationary backdrop.
Yeah, and it may be transitory. That's certainly what we heard from Bill Dudley. We need to say thank you to our team for putting together a great focus on inflation through the day. This is important. Coming up tonight on Balance of Power, a timely conversation with the senator from the Commonwealth of Massachusetts, Elizabeth Warren. Stay with us. This is Bloomberg